Good evening, everyone. ಏನಾಯ್ತು nobody is here. ಒಂದು ಮೆಸೇಜ್ ಹಾಕಿ
Yes, sir.
ಬೇಗ ರಮ್ಯಾ and all of them quickly. Technically, everybody should have attended this class. ಯಾಕಂದ್ರೆ I told no theory, I'll be covering it in this class. Yes. ಏನಾಯ್ತು ತನುಶ್ರೀ? ಹೇಳಿದ್ದಲ್ವಾ ನಾನು intentionally kept for the last session ಯಾಕಂದ್ರೆ ಥಿಯರಿ ನಿಮ್ಗೆ ಮರ್ತೋಗುತ್ತೆ ಅಂತ. Okay, anyway, let us start. Their luck and ಇದು ಅಷ್ಟೇ, ನನ್ಗೇನ್ ಮಾಡಕ್ಕಾಗಲ್ಲ. All right. So you started with the capital budgeting, all of you? Yes, completed? Huh? No, not yet. All right. Quickly, let me summarize. Listen now. Yesterday itself, I had given you an introduction on capital budgeting. At least the important points I had covered. Correct? Let's quickly revise those points. Sit straight, everybody. Yes. Capital budgeting. Basically, it is about the investing decisions, correct or not? Whether a project is viable or not, we decide through capital budgeting. Yes. Financing decision only, we used cost of capital chapter to analyze which is the source of capital having the least cost. What we understood in capital structure is the optimum capital structure is that capital structure where the weighted average cost of capital is the least. Yes. And what should be the combination of equity and debt? Through leverages, we learned about trading on equity, right? All of these are financing decision related. This is about procurement, right? Now this procured funds should be invested somewhere. That is what is decided in investment decisions or capital budgeting, correct? First point is that it should be in line with the objectives of the company. Clear, all of you? Yes. Rajeshri, are you there? Akshaya, first of all, number is less. At least who are there, keep the videos on. Yes. Last class only, I don't know why so many people have not come today. Yes. Okay. Listen now. It should be in line with the long-term objective of the company. Only when it is in line with the long-term objective of the company, yes, will you get into the evaluation stage. Otherwise, it does not even enter into the evaluation stage. Clear? Evaluationally, we need to know all the capital budgeting techniques, correct? All the capital budgeting techniques. What are the capital budgeting techniques? First one is NPV method, that is net present value, wherein the present value of cash inflow should be more than the present value of cash outflow, correct? Present value of cash inflow minus present value of cash outflow is the net present value. If NPV is greater than 1, you will accept it. If it is in negative, then you will reject. Clear? Then we learned about profitability index, which indicates for every 1 rupee invested, what is the present value of cash inflow generated. NPI is formula for profitability index is what? Present value of cash inflow divided by cash outflows. The present value of the cash outflows. Clear, all of you? Right? That is PI. NPI is what? PI minus 1. Right? PI minus 1. So NPI is equals to net present value divided by present value of cash outflows. Clear? Right? Then we learned about IRR, internal rate of return, wherein all the intermediate cash flows are reinvested at IRR itself. The assumptions under IRR is that the intermediate cash flows are reinvested at IRR. Present value of the cash inflow is equals to present value of cash outflow. That is, at IRR, NPV is equals to 0. At IRR, NPV is equals to 0. Then we learned about interpolation, right? How do we interpolate? Correct or not? First, take a lower rate, identify what the NPV is at lower rate. Clear, all of you? Then take a higher rate, find out what is the NPV at higher rate is, right? At the lower rate, you will get an NPV. At the higher rate, you will get an NPV. Everybody able to understand? Right? Lower rate normally NPV will be positive, higher rate NPV will be negative. You interpolate it such that find out what is the rate at which NPV is 0. That is cross multiply. Cross multiply, and then you'll get what is the NPV at which, what is the IRR rate at which NPV is 0, and that rate is nothing but IRR. Formula also we had learned, right? That is lower rate plus NPV of lower rate divided by NPV of L minus NPV of H into H minus L. Clear all of you? That is the formula for calculating IRR. Under IRR, the assumption is the intermediate cash flows are reinvested at IRR, which is a very aggressive assumption. Correct or not? It need not be that I will find another project. I will find another project wherein this can be invested. Understood, everybody? Therefore, modified internal rate of return takes a more pragmatic approach, takes a more realistic approach, assuming that intermediate cash flows need not be invested at IRR. It may be invested at another rate of return, normally taken at KO. Therefore, all the intermediate cash flows at KO you extrapolate it to the last year, terminal year, and there you discount the terminal year cash flows to the present year. Understood? Now, the rate at which Nityasri you discount that cash flow is called MIRR, right? So that cash flow, when you equate it with the present value of cash outflow, that is nothing but MIRR. Clear, all of you? Yes. Then payback period you learned the number of years in which the amount that is invested is repaid back. When you do not consider without time value of money, it is just called payback period. When time value of money is considered, it's called discounted payback period. Is it clear? Right? Now, the most important thing is the analysis of cash flows. There are three cash flows: initial investment, intermediate cash flows, and terminal cash flows. Initial investment or cash outflows, correct or not? That can be capital as well as working capital. That is, it could be fixed assets as well as working capital. Understood? Fixed assets as well as working capital. Intermediate cash flows is your CFAT, wherein EBAT you find out less depreciation, less tax, earnings after tax, add back depreciation. Interest is not subtracted here because of finance cost exclusion principle, which I had explained it in the class. Because of finance cost exclusion principle, interest cost is not subtracted. However, depreciation is subtracted first, find out the tax, earnings after tax, and then add back depreciation. This is called CFAT. This is called CFAT. Clear, all of you? Right? Now, CFAT you consider for your intermediate cash flows, and terminal cash flow is a cash inflow wherein you have normally two cash inflows. One is your scrap value of the fixed asset. Second is the working capital which is recovered. If the question is silent, yes. If the question is silent, we assume what? We assume that the terminal working capital is recovered at the end of the project. Clear, all of you? Yes. We assume that it is recovered at the end of the project. Okay. All right. Write down. Open your notebook. ಏನೇ ರೆಕಾರ್ಡ್ ಆಗ್ತಿಲ್ಲ ಇಷ್ಟಕ್ಕ.
ನೋ ಸರ್, ಲೈಕ್ ಸ್ಟೋರೇಜ್ ಫುಲ್ ಇತ್ತು, ಸೊ ಈಗ ಕ್ಲಿಯರ್ ಮಾಡಿದ್ರು. ಸೊ ಬಟ್ ಯೂಟ್ಯೂಬ್ ಆಗ್ತಿತ್ತು ಸರ್, ಸೊ
Okay.
ಡೌನ್ಲೋಡ್.
Write down. Capital budgeting. Capital budgeting. NPV or first write capital budgeting techniques. Capital budgeting techniques. NPV. NPV. Write down. NPV is not profit. NPV is not profit. It is the wealth created. It is the wealth created by accepting or rejecting a project. It is the wealth created by accepting or rejecting a project. NPV is equals to present value of cash inflow minus present value of cash outflow. Write down decision. If NPV is greater than 1, accept. NPV greater than 1, accept. NPV, so greater than 1, actually it is greater than 0. greater than 0. That is NPV is positive, accept. NPV negative, reject. NPV positive, accept. NPV negative, reject. Okay. Next, PI, profitability index. Profitability index. PI is equals to present value of cash inflow. Use shortcuts, huh? PV, CI. Next, divided by present value of cash outflow. PV of CO. Right? Below that, write down. If it is greater than 1, accept. Less than 1, reject. Greater than 1, accept. Less than 1, reject. Next, number 3, NPI. NPI, net profitability index. Formula NPV divided by present value of cash outflow. Present value of cash outflow. If it is less than 0, reject. Greater than 0, accept. Less than 0, reject. Greater than 0, accept. Another formula is PI minus 1. Another formula is PI minus 1. PI minus 1. Write down below that. When capital is scarce, use PI to rank the projects. Use PI to rank the projects within bracket, like limiting factor problems, like limiting factor problems, like limiting factor problems, like limiting factor problems. Next, IRR. Next one, write down IRR. Write down at IRR, present value of PV of CI is equals to PV of CO. PV of CI is equals to PV of CO. Next, NPV is equals to 0. NPV is equals to 0. NPV is equals to 0. Next point, intermediate cash flows. Intermediate cash flows reinvested at IRR. Reinvested at IRR. Write down IRR is equals to L plus NPV of L. NPV of L. NPV of L divided by NPV of L minus NPV of H. This into within bracket H minus L. Within bracket H minus L. ನಿಮಗೆ ಕಾಮನ್ ಸೆನ್ಸ್ ಅಪ್ರೋಚ್ ಐ ಹ್ಯಾವ್ ಆಲ್ರೆಡಿ ಟಾಟ್ ಯು ಗೈಸ್. ಎಸ್ ಇನ್ ದ ಕ್ಲಾಸ್ ಅದನ್ನು ಗೋ ಥ್ರೂ ಮಾಡಿ. ಓಕೆ, ರೈಟ್ ಡೌನ್ IRR greater than KO, accept. IRR greater than KO, accept. IRR less than KO, reject. IRR less than KO, reject. But next, payback period. Or sorry, we will below IRR write down MIRR, modified internal rate of return. It assumes that the intermediate cash flows are reinvested. It assumes that the intermediate cash flows are reinvested at a rate, so at KO within bracket or any other percentage, within bracket or any other percentage. For this, you'll have to draw a number line. Only then you'll understand. Draw the number line, timeline, write down 0, 0. That is year, okay. Write year and then cash flows. Year in one line, cash flow below that. Year, cash flows. In year 0, 1, 2, 3, 4. Cash flows. Nikhil, did you understand? Year horizontal. Year 0, 1, 2, 3, 4. Right? Then cash flows. Only first year minus anything, minus 500, minus 500. Then 120. Year 1, 120. Year 2, 200. Year 2, 200. Year 3, 180. Year 4, 500. Some numbers. Okay. What do you do now? Year 1 cash flow. First year 4 in the year 3 in the start ಮಾಡಿ. Year 3 take it to year 4. Year 3 take it to year 4. Right? And right. Arrow mark ಗೆ below that arrow mark or above the arrow mark you have to write into within bracket 1 plus KO to the power 1. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? You want me to write it down? Able to understand? 1 plus KO to the power 1. Next, year 2 ದು cash flow take it to year 4. Year 2 ಅಲ್ಲಿ ಏನ್ ಬರೀತೀರಾ? 1 plus KO
To the part 2.
to the power 2. Then first year cash flow 1 plus KO to the power 3. ಜಸ್ಟ್ ಪುಟ್ ಆರೋ ಮಾರ್ಕ್ ಏನು ಕ್ಯಾಲ್ಕುಲೇಟ್ ಮಾಡಬೇಡಿ. ಇಯರ್ 4ಗೆ ಒಂದು ಬಾಕ್ಸ್ ಹಾಕಿ, ಎಲ್ಲ ಆರೋ ಮಾರ್ಕ್ಸ್ ಅಲ್ಲಿ ಬರುತ್ತೆ. ಇಯರ್ 4 ಕ್ಯಾಶ್ ಫ್ಲೋ ಪ್ಲಸ್ ಆಲ್ ದೀಸ್ ಆರೋ ಮಾರ್ಕ್ಸ್, ಪುಟ್ ಅ ಬಾಕ್ಸ್. ಡಿಡ್ ಯು ಅಂಡರ್ಸ್ಟ್ಯಾಂಡ್? That means you took third to fourth year, second to fourth year, first to fourth year, including the fourth year cash flow. Put a box and then put a arrow mark to first 0 year. Put a arrow mark to today, right? Arrow mark ke you will put what? Anybody? Yes, Niteshri, you know.
Divided.
Yes, into 1 divided by only 1 by 1 plus KO to the power 1 plus KO to the power how many years? ಅಲ್ಲೇ ಇದೆ ಅಲ್ಲ, 4 years. ಎಸ್, ಭಯ ಜಾಸ್ತಿ ಅಷ್ಟೇ. 4 years. 1 plus KO to the power 4 years. ಏನಾಗ್ತಿದೆ? ಐ ಆಮ್ ರಿಮೂವಿಂಗ್ ಮೈ ಸ್ಪೆಕ್ಸ್ ಬಿಕಾಸ್ ನನ್ ಕ್ಲಿಯರ್, ಐ ಕ್ಯಾನ್ ಸಿ ದ ಕ್ಲಿಯರ್. ಹಾಕಿದ ತಕ್ಷಣ ಹೋಗ್ತಾ ಇದೆ. ಎಸ್, ರೈಟ್ ಡೌನ್ 1 KO to the power 4 years. Next, that is MIRR. Okay. Next, payback period. In how many years? In how many years slash months slash weeks? That is time period. That is time period. In how many years slash months slash weeks? That is time period. Will the initial investment be recovered? Will the initial investment be recovered? That is payback period for you. Write down year, year. ಈಗ ಹಾರಿಜಾಂಟಲ್ ಅಲ್ಲ, ವರ್ಟಿಕಲ್ ಮಾಡಿ. ಇಯರ್ 0, 1, 2, 3, 4. 0, 1, 2, 3, 4. Cash flows. Next, second column, cash flows. Same thing copy ಮಾಡಿ, IRR ಮಾಡಿದ್ದು ಕಾಪಿ ಮಾಡಿ. -500. Next, yes, year 1 is how much?
120.
120. Then
Year 2, 200.
200.
Year 3, 180.
ಕಮ್ಮಿ ಆಯ್ತು, ಒಂದು ಜಾಸ್ತಿ ಮಾಡು ಅದನ್ನ. ಇಯರ್ 1 120, then 200 ಇರಲ್ಲ.
200.
Okay, then is how much?
180.
Okay, 180. Next,
500.
okay, ಅದನ್ನ 180, 500. Done.
Yes, sir.
Okay. Next column, cumulative cash flows. Cumulative cash flows ಮಾಡ್ತಾ ಹೋಗಿ. Yes, -500. Year 0 -500. Yes, year 1 how much?
-3.
-380. Next, year 2
-8.
minus
80.
ರೇಟಿಂಗ್ ಆಗುತ್ತೆ. ಇಯರ್ 2 ಕ್ಯಾಶ್ ಫ್ಲೋ ಎಷ್ಟು?
200.
Year to 200.
180 ಇಯರಾ?
Yes, sir.
ನಿತ್ಯಶ್ರೀ ಏನಾಯ್ತು, ಕನ್ಫ್ಯೂಸ್ ಆಯ್ತಾ? ಮಾಡ್ಬೇಕಾ ನಾನು ಸ್ಕ್ರೀನ್ ಮೇಲೆ?
ಇಲ್ಲ ಸರ್, ಅರ್ಥ ಆಯ್ತು.
ಮಾಡ್ತೀನಿ, ನಂಗೇನಿಲ್ಲ, ಪರವಾಗಿಲ್ಲ. ಐ ಥಾಟ್ ಇಟ್ಸ್ ಯು ಗೈಸ್ ಆರ್ ಡೂಯಿಂಗ್ ಇಟ್ ಅಂತ. ಇಲ್ಲಂದ್ರೆ ನಾನು ಮಾಡ್ತೀನಿ, ಐ ಹ್ಯಾವ್ ನೋ ಇಶ್ಯೂಸ್. ಟ್ರ್ಯಾಕ್ ಸಿಗ್ತಾ ಇದೆ ಅಲ್ಲ ಎಲ್ರಿಗೂ? ಆರ್ ಯು ಆರ್ ಗೆಟಿಂಗ್ ಇಟ್?
Yes.
ಹಾ, ಇಯರ್ 1 ಎಷ್ಟು ನೀವೇ ಹೇಳಿ. ಓಕೆ ಭಾವನಾ, ಟೆಲ್ ಮಿ. ಇಯರ್ 0 ಇಸ್ -500. -500 ಪ್ಲಸ್ ಇಯರ್ 1 ಕ್ಯಾಶ್ ಫ್ಲೋ ಎಷ್ಟು?
120. So
-500 ಪ್ಲಸ್ 120 ಹೌ ಮಚ್?
-380.
ಪ್ಲಸ್
Plus 200. So -180.
-180. ನೆಕ್ಸ್ಟ್ ಪ್ಲಸ್
Plus 180. So 0.
ಓ 0 ಆಗ್ಬಿಡುತ್ತಾ?
Yes, sir. Yes, sir.
ಓಕೆ, ಕೋಇನ್ಸಿಡೆನ್ಸ್. ಓಕೆ, ರೈಟ್ ಡೌನ್ ಅಲ್ಲಿ 0 ಅಂತ ಬರ್ರಿ. ಓಕೆ 0. ನೆಕ್ಸ್ಟ್ ಇಯರ್
Next year is
Next year?
500. So 500.
So therefore payback period is how much here? A 0 circle ಮಾಡಿ. 0 circle ಮಾಡಿ. What is the payback period? What is the payback period? 3 years. 3 years. 3 years ಅಲ್ಲಿ ರಿಕವರ್ ಆಯ್ತಲ್ಲ, ಸುಪ್ರಜ್ಞಾ 0 ಆಯ್ತಲ್ಲ NPV. So 3 years. ಓಕೆ, ನೆಕ್ಸ್ಟ್ ಅದೇ ಪಕ್ಕದಲ್ಲಿ ಇನ್ನೊಂದು ಹಾಕಿ, ಕೇಸ್ 2. ಅಲ್ಲೇ ಪಕ್ಕದಲ್ಲಿ ಇನ್ನೊಂದು ಹಾಕಿ, ಕೇಸ್ 2. -500. Keep that 180, 120 as it is. Year 1 ಅಷ್ಟೇ. Year 1 ಎಷ್ಟು? 120. Year 2 is how much?
200.
200. Keep it 200 only. Year 3 make it 100. Year 3 make it 100. Year 4 500 only. Clear? Year 4 500 only. ಅರ್ಥ ಆಯ್ತಾ?
Yes,
So
sir.
-500, then it is 120, then it is 200, then 100, and then 500. Clear all of you? This is case 2. ಈಗ ಕ್ಯುಮ್ಯುಲೇಟಿವ್ ಕ್ಯಾಶ್ ಫ್ಲೋ ಮಾಡಿ ಬೇಗ. -500, then -380, then -180, then -80, correct?
Yes, sir.
-80, and next year it is positive 420, correct? Positive 420. ಅಲ್ಲಿ the last year where it is negative ಅದನ್ನ ಸರ್ಕಲ್ ಮಾಡಿ. The last year where it is negative ಅದನ್ನ ಸರ್ಕಲ್ ಮಾಡಿ. ಗೊತ್ತಾಗ್ತಾ ಇಲ್ವಾ? ಮಾಡ್ಬೇಕೇನೆ ಭಾವನಾ?
ಗೊತ್ತಾಯ್ತು ಸರ್.
No, seriously, you guys are looking blank. Okay, ಚಲೋ.
ಅಲ್ಲ ಸರ್, ಕೋಇನ್ಸಿಡೆಂಟ್ ಆಗಿ 420 ಅಂತ ನಂಬರ್ ಬಂತಲ್ಲ, ಅದಕ್ಕೆ ನಮ್ಗಳ ರಿಯಾಕ್ಷನ್.
ಓಕೆ ದೆನ್ ಓಕೆ, ಆಮೇಲೆ ಎಷ್ಟಾದ್ರೂ ಪರವಾಗಿಲ್ಲ. 420. ಓಕೆ, ಅಲ್ಲಿ ಕೆಳಗಡೆ ಬರೀರಿ. ಅದು ಲಾಸ್ಟ್ ಇಯರ್, ಥರ್ಡ್ ಇಯರ್ಗೆ ನೀನೆಲ್ಲೋ ನಂಬರ್ಸ್ ಕೊಟ್ಟಿದ್ದೆ, ಅದಕ್ಕೆ ಥರ್ಡ್ ಇಯರ್ ಸರ್ಕಲ್. Where third ಅಂದ್ರೆ basically you need to circle the last year. You to write circle the last year where it is negative cash flow. ಅಲ್ಲಿ ಬರ್ಕೊಳ್ಳಿ ಅದನ್ನ. You will not know tomorrow why you circled it. Circle last year where it is negative cash flow. Understood? Last year with negative cash flow should be circled. 0 ಆದ್ರೆ ದಯವಿಟ್ಟು ಅದನ್ನ ಮಾಡಬೇಡಿ. 0 ಅಂದ್ರೆ obviously 0 ಆಗೋಯ್ತು. If none of the years are 0, then circle last year with negative cash flow. Clear all of you?
Yes,
Right? ಅದು ಕ್ಯಾಶ್ ಫ್ಲೋ ಸರ್ಕಲ್ ಮಾಡಿ, ಇಯರ್ ಕೂಡ ಸರ್ಕಲ್ ಮಾಡಿ. ಓಕೆ, ಆ 80 ಇದೆಲ್ಲ ಪುಟ್ ಅ ಕ್ರಾಸ್ ಸ್ಲ್ಯಾಂಟ್ ಡೌನ್ವರ್ಡ್ ಆರೋ ಮಾರ್ಕ್ ಟು ಇಯರ್ 4 ಕ್ಯಾಶ್ ಫ್ಲೋ. ಇಯರ್ 4 ಕ್ಯಾಶ್ ಫ್ಲೋ ಎಷ್ಟಿದೆ? 500.
yes.
ಪುಟ್ ಈ ತರ ಕನೆಕ್ಷನ್ ಕೊಡಿ, 80 ಕನೆಕ್ಷನ್ ಟು 500. ಓಕೆ, ಬರೀರಿ ಕೆಳಗಡೆ. ಪೇ ಬ್ಯಾಕ್ ಪೀರಿಯಡ್ ಇಸ್ ಈಕ್ವಲ್ಸ್ ಟು 3 plus 80 by 500. ಅರ್ಥ ಆಯ್ತಾ? I'm supposed to recover 80, but I'm recovering 500 in the entire year. So proportionate agi we are doing it, right? So 3 plus 80 by 500, how many years?
3.16.
3.16 years the payback period. Next, discounted payback period. Write down. Same as payback period. However, ಬರಿಬೇಕು. Next one, discounted payback period. Next heading, ನಿತ್ಯಶ್ರೀ ಏನಾಯ್ತು? ಇಲ್ಲೋಸ್ ಟ್ರ್ಯಾಕ್
ಸರ್ ಏನೋ ಲ್ಯಾಗ್ ಆಗಬೇಕು.
ಭಾವನಾ, ಇಸ್ ಇಟ್ ಲ್ಯಾಗಿಂಗ್?
ಆಗ್ಲೇ ಸ್ವಲ್ಪ ಇತ್ತು ಸರ್, ಇವಾಗ ಇಟ್ಸ್ ಫೈನ್.
ಇಟ್ಸ್ ಫೈನ್. ಐ ವಾಸ್ ಸೇಯಿಂಗ್ ಅದಾಯ್ತಲ್ಲ, ಪೇಬ್ಯಾಕ್ ಪೀರಿಯಡ್ 3.16 ಆಯ್ತಾ ನಿತ್ಯಶ್ರೀ? ನೆಕ್ಸ್ಟ್ ಒನ್
ಆಯ್ತು.
ಐ ಟೋಲ್ಡ್ ಡಿಸ್ಕೌಂಟೆಡ್ ಪೇಬ್ಯಾಕ್ ಪೀರಿಯಡ್. ಇಲ್ಲಿ ಕರೆಂಟ್ ಬರ್ತಾ ಇದೆ, ಹೋಗ್ತಾ ಇದೆ, ಐ ಡೋಂಟ್ ನೋ ವಾಟ್ ಇಸ್ ಹ್ಯಾಪನಿಂಗ್. ಓಕೆ, ಕರೆಂಟ್ ಹೋಗ್ತಾ ಇದೆ, ಜನರೇಟರ್ ಆನ್ ಆಗ್ತಾ ಇದೆ, ಕರೆಂಟ್ ಬರ್ತಾ ಇದೆ, ಜನರೇಟರ್ ಆಫ್ ಆಗ್ತಾ ಇದೆ, ಮತ್ತೆ ಕರೆಂಟ್ ಹೋಗ್ತಾ ಇದೆ, ಜನರೇಟರ್ ಆನ್ ಆಗ್ತಾ ಇದೆ. ಐ ಡೋಂಟ್ ನೋ ವಾಟ್ ಇಸ್ ಹ್ಯಾಪನಿಂಗ್. ಎನಿವೇ, ಅಂಡ್ ಇಲ್ಲಿ ಲೈಟ್ ಬೇರೆ, ಅದು ಆನ್, ಅದ್ರಲ್ಲಿ 3 ಕಲರ್ ಇದೆ, ಅದು ಆಫ್ ಆದ್ರೆ ಎಲ್ಲೋ ಆಗುತ್ತೆ. ಮತ್ತೆ ಅದನ್ನ ವೈಟ್ ಮಾಡ್ಬೇಕು. ಒಳ್ಳೆ ಇದೇ ಕಥೆ ನಿಮ್ಗೆ. ಎಸ್, ಬರೀರಿ ಬೇಗ ಬೇಗ, ಟೈಮ್ ಇಲ್ಲ. ಸೋ ಮಚ್ ಟು ಕವರ್ ಟುಡೇ. ಅಲ್ಲಿ ಡಿಸ್ಕೌಂಟೆಡ್ ಪೇ ಬ್ಯಾಕ್ ಪೀರಿಯಡ್ ಸೇಮ್ ಆಸ್ ಪೇ ಬ್ಯಾಕ್ ಪೀರಿಯಡ್. ಡಿಸ್ಕೌಂಟೆಡ್ ಪೇ ಬ್ಯಾಕ್ ಪೀರಿಯಡ್ ಸೇಮ್ ಆಸ್ ಪೇ ಬ್ಯಾಕ್ ಪೀರಿಯಡ್. Same as payback period. Yes. But consider time value of money. Time value of money, that is discounted cash flows. But consider time value of money, that is discounted cash flows. Discounted cash flows. Next, below that, when annuity is given, ಇದು actually payback period ಅಲ್ಲಿ ಬರಬೇಕಿತ್ತು. Write down, when annuity is given, payback period is equals to initial investment ಇದು next point ತರ ಬರೀರಿ. Don't write under discounted payback period. This is for payback period. Annuity is equals to initial investment divided by annuity. ಇದಕ್ಕೆ upward arrow mark to payback period, upward arrow mark to connect ಮಾಡಿ, ಅದಕ್ಕೆ ಕನೆಕ್ಟ್ ಮಾಡಿ. It is not discounted payback period. Very very important point. ಇದ್ರ ಕೆಳಗಡೆ very very important point. Payback period ignores discounted payback period also ignores. ಆಯ್ತಾ? Payback period / discounted payback period ignores cash flows after the payback period is achieved. Payback period ignores cash flows after the payback period is achieved, or initial investment is recovered. Therefore, it is short term in nature. And does not consider time value of money. Next, last one, ARR, accounting rate of return. Use income instead of cash flows. ARR is equals to average profit divided by initial investment into 100. Average profit divided by initial investment into 100. Next, project cash flows. 3 arrow marks. First one, initial investment. Second one, operating cash flows / intermediate cash flows. Third arrow mark, terminal cash flows. ಅಲ್ಲಿ initial investment ಅಲ್ಲಿ 2 arrow marks, fixed assets, working capital. Intermediate cash flows ಗೆ put an arrow mark and write down CFACT. Consider CFACT. That is EBIT into 1 minus T. EBIT into 1 minus T plus depreciation. EBIT into 1 minus T plus depreciation, or NOPAT plus depreciation, or NOPAT plus depreciation. ಇದು ಆಪರೇಟಿಂಗ್ ಕ್ಯಾಶ್ ಫ್ಲೋಸ್ ಅಂಡರ್ ಅಲ್ಲಿ NOPAT plus depreciation. That is, first deduct depreciation. First deduct depreciation. First deduct depreciation. Calculate tax. Calculate tax. Below that, add depreciation to PAT. Add depreciation to PAT. Understood? Add depreciation to PAT. Next point. Don't consider or do not deduct interest. Do not deduct interest within bracket. Finance cost exclusion principle. Finance cost exclusion principle. Terminal cash flows ಅಲ್ಲಿ 2 arrow marks. First one, salvage value. Salvage value. Last one, recovery of working capital. Recovery of working capital. Yes. If I'm going fast, you just let me know. I'll go a little slow. Okay. Recovery of working capital. Recovery of working capital. Put a downward arrow mark and write down. Presumed. 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 Even if the question is silent. Presumed. Even if the question is silent. Right? Right? Within bracket. Recovered in the last year. Recovered in the last year. Next, cash flows are, next below the chart, cash flows are presumed to be incurred at the end of the financial year. At the end of the year, Aste. At the end of the year, cash flows are presumed to be incurred at the end of the year. Next time. Therefore, if it is paid in advance, if it is paid in advance, that is at the beginning of the year, consider such cash flows in the previous period. Next, if accounting and income tax depreciation rates are given, consider income tax. Next, when an expense is paid in advance, number one, first deduct on accrual basis. Right? Calculate PAT. Next, add back on accrual basis. Next, deduct on cash basis. Did you understand? Yes, I repeat. First, you deduct on accrual basis, because income tax you're assuming is on accrual basis, but we want on cash basis. So minus accrual basis, calculate the tax, calculate PAT, add back on accrual basis, and then minus on cash basis. Did you understand? Yes, we've done this problem in the class. I'm just recalling the adjustment for your step. It's an important adjustment. You can go through the problem done in the class. All right. Next. Next point. If Next point, if initial investment is not entirely paid, if initial investment is not entirely paid at t is equals to 0, right? Say 50% paid now, 50% paid now, 50% at the end of year 1, 50% at the end of year 1. Write down. Do not consider in operating cash flows. Do not consider in operating cash flows. Consider it as part of investment itself. Consider it as part of investment itself. However, discount for 1 year. However, discount for 1 year. Are you understanding? Yes, discount for 1 year. Next. Next point. Ignore sunk cost. Ignore sunk cost. That is cost already incurred. Cost already incurred. Example, R&D, R&D within bracket past, future ಕೊಟ್ರೆ consider ಮಾಡಿ. Past ನಾನು ಹೇಳ್ತಾ ಇರೋದು. R&D within bracket past. Next, survey, marketing and survey, marketing and survey. Acquisition cost 10 years ago. Acquisition cost 10 years ago. Example ಅಷ್ಟೇ. Next point. Consider opportunity cost. Consider opportunity cost. Next, ignore existing allocated overheads. Ignore existing allocated overheads. Next, consider incremental costs. Consider incremental costs. Consider incremental costs. Next, mutually exclusive projects. Mutually exclusive projects with unequal lives. With unequal lives. Write down. ಅದಕ್ಕೆ 2 marks. First one is annual equivalent NPV. Annual equivalent NPV is equals to NPV divided by PVAF. PVAF. NPV divided by PVAF. Right hand side. LCM method. LCM method. Within bracket. Replacement chain. Replacement chain method. Right? Right hand side is not that important. AEPV. Annual equivalent NPV important. Annual equivalent NPV important. Write down. The underlying assumption to follow to follow AE and PV slash LCM. The underlying assumption to follow AE and PV slash LCM is that the projects are repeatable. Is that the projects are repeatable? Is that the projects are repeatable? Next. Next, say no revenue information, and unequal lives. Use annual equivalent cost. Annual equivalent cost. Annual equivalent cost. Annual equivalent cost. Next. Replacement of machine. Replacement of machine within bracket. Old minus new. That is consider incremental cash flow. Consider incremental cash flow. Next, below that, depreciation may be calculated on block concept. If specifically given in the question. Okay. Ali, ade only consider incremental cash flows. Adu ಹೇಳಿದ್ದೀನಲ್ಲ. For this, no, you should always consider incremental cash flows. In that's all. Yeah. Let's go through the caps material. You all go through it. Okay. Even the revision material. Yes, Supragna.
So for discounted payback period, you told that it considers time value of money, but in the note you've given that it does not consider time value of money.
I was giving the next point that was not under discounted payback period. I told you the payback period though. I gave you some additional notes. I told you to put an arrow mark also above. ಹೇಳಿದಲ್ಲ.
Sir, payback period slash discounted payback period ignores cash flows
ಓದು.
after the payback period. Sir,
ಓದು.
payback period or discounted payback period ignores cash flows after the payback period is achieved.
Okay,
or
discounted
initial
payback
investment is
period
recovered.
ignores obviously ignores the cash flows after the payback period is achieved, but payback period ignores time value of money. ಅಷ್ಟೇ. The first point is applicable for both. You can make a note as a discounted payback period scratch ಮಾಡ್ಬಿಡು. Better. You will not get confused. Okay. ಅಲ್ಲಿ discounted payback period you scratch it off. Okay. Yes. Okay, so these are the important adjustments that are frequently asked. What I could recall, obviously there are too many adjustments in capital budgeting that can come. For that, you have to practice. Okay. Let us go through the RTP. This we did. Yes, come to this question. Equilease Financial Services Limited is a specialized equipment leasing company that has been operating in the industrial equipment financing space for over 15 years. The company's model involves purchasing high value machinery and leasing it to manufacturing companies, thereby earning returns to lease rentals while retaining ownership of the assets. The company has built a strong reputation for providing flexible financing solutions tailored to clients' cash flows, patterns, and business cycles. Their leasing arrangement helps clients conserve capital while accessing state of the art equipment. Equip Lease has recently purchased a specialized CNC precision machine with the following information. Purchase cost 10 lakh, paid upfront T0. Make a note that T0. Expected useful life T is equals to 4 years or N is equals to 4 years. Useful residual value 0. Depreciation for tax purposes can be claimed by Equilip under straight line method or units of production method. Lease rentals earned by company is subject to tax. Equilip's cost of capital is 10% per annum, corporate tax rate 25%. Tech Manufacture Industries Limited, a growing precision engineering company, has approached Equilip expressing interest in leasing this CNC machine. Tech Manufacture has provided detailed information about their expected utilization pattern. The machine's usage will follow a graduated ramp up pattern based on the order book projections, right? So, production capacity utilization low initial phase, then medium in the second year, high, and then peak in the fourth year. Relative units 1, 2 units, 3 units, and 4 units. So, you have to use the units of production method, they said, correct? This pattern is typical for business scaling up production with new equipment, starting slow as operators are trained and processors are optimized, then ramping up to full capacity. The client wants the company to charge lease rentals based on the client's utilization pattern of 1 is to 2 is to 3 is to 4. Mr. Vikram Malhotra, the Chief Credit Officer at Equip Lease, is tasked with structuring an appropriate lease arrangement. He faces several strategic decisions. How much portion of the cost is recovered from tax savings on depreciation under both the methods, that is SLM and units of production method? So basically very simple, calculate depreciation and the tax on it. Did you understand? Calculate depreciation and the tax on it. Simple. Next, find the portion of the investment to be recovered from lease rentals under both the assumptions that depreciation under both methods, that is SLM and units of production method. Determine minimum lease rentals needed to recover the balance cost of investment under after adjusting the tax shields on the depreciation under both the depreciation methods if equip lease charge uniform rentals over 4 years. If the lease rentals follow the client utilization pattern of 1 is to 2 is to 3 is to 4. Yes, I don't see much adjustments here. Okay, it's pretty straightforward. Write down. Yes. Question number ಏನು?
8, sir.
Question 8, RTP May 2026. Yes. So first question they've asked you what? The tax savings, correct? Tax savings.
Yes.
So Roman number 1 under SLM method. Under SLM method, first calculate depreciation is equals to, yes, what is the cost?
10 lakh.
10 lakh. Okay. Yes, here it is. Cost is 10 lakh divided by 4 years. Is there any salvage value? No, 0. 10 lakh by 4 years, what's the depreciation? 2.5 lakh. 2.5 lakh. It is constant year on year. Therefore, to find out the present value, write down present value of depreciation is equals to 2.5 lakh into present value annuity factor within bracket. What is the cost of capital given? The cost of capital
10% per annum.
is 10% per annum. 10% for how many years? 4 years.
Oh,
Calculate and tell me. I don't think. Have they given? They have not given the present value factors. You need to calculate. Calculate and tell me how much are you getting?
3.169.
3.1. Next digit?
9.
1699. Therefore, into 3.170. Ready? Yes. How much is this? ಬೇಗ ಇವತ್ತು ಹೇಳ್ತೀರಾ ನಾಳೆ ಹೇಳ್ತೀರಾ?
7,92,500.
7 lakh
92,500.
So that is the total, right? Correct. Allah, they have asked the tax advantage, am I right? So you have to multiply into tax rate. Tax rate. What is the tax rate?
25%.
5%.
So present value of tax advantage on depreciation. Tax advantage on depreciation. Yes. How much is this? That is 25%. Multiply and tell me. 2.5 lakh into 3.170 into 0.25. How much? Split it and tell. 2 lakh 50 into 3.10 into 25%. How much? Quickly.
1,98,125.
1,98,125. 1,98,125. Yes. Next. This is for SLM. Next, units of production method. Number 2. Units of production method. Under that, year 0. ಅಲ್ಲ ಇಯರ್ 0 ಇಲ್ಲಿ ಬರೋದಿಲ್ಲ. ಇನಿಷಿಯಲ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ ಏನಿಲ್ಲ. ಸೊ 1 2 3 4 depreciation 10 lakh into 1 lakh divided by 1 lakh units divided by 1 plus 2 plus 3 plus 4. How much? 1 plus 2 plus 3 plus 4. How much? 10.
10.
Therefore, it will be the same as the value of the year itself. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? Is equals to 1 lakh, 2 lakh, 3 lakh, 4 lakh depreciation. Therefore, tax on depreciation or tax savings or advantage, tax advantage, yes, into 25%, 25,000, 50,000, 75,000, 1 lakh. Present value factor at 10%. Tell me 3 decimal places. Institute normally consider 3 decimal places. ನಾನು ಎಷ್ಟು ನೆನಪಿದೆ ನಾನು ಮಾಡ್ತಾ ಹೋಗ್ತೀನಿ. 0.909, 0.826, 0.751. Next year you have to help me. Next year you have to help me. I don't remember. 0.1 divided by 1.1 equal to
683.
683. Multiply present value of the cash flows and then total it. Yes, ಮಾಡಿ ನೀವೇ ಮಾಡಿ total ಹೇಳಿ ನಂಗೆ ಡೈರೆಕ್ಟ್ ಆಗಿ. Tell me the total answer. Quickly do it and tell me the total answer.
One lakh 89,100.
1,89,100. Correct. 1,89,100.
One lakh 88,650.
650.
88,6.
Others,
It's 1,88,650.
Yes, sir.
1,88,650.
don't make silly mistakes. 1,88,650. Okay. Everybody got it? Can we move ahead?
Yes,
sir.
The next requirement of the question. Check. Find the portion of the investment to be recovered from lease rentals under both the assumptions, that is depreciation under both methods, that is SLM and units of production method. Okay, let's do it. So we don't know what the lease rental is. Write down. Let lease rental, this is second sub question. Let lease rental of proportionate to the units of production. Allah. It's 1, 2, 3, 4. So you can say let lease rental of first year equal to X. Let lease rental of first year equal to X. Okay. Now let's draw a table. Years. So this is obviously under units of measurement. That is based on adenidedo. So you can lease rental under both assumptions. Depreciation under both methods, SLM and units of production method. And minimum lease rentals needed to recover the balance cost of investment after adjusting the tax sheets on the depreciation under both depreciation methods. If it charges uniform, it charges based on client utilization pattern. Okay. So do it. So this is based on, write down, client utilization pattern. Client utilization pattern, years 1, 2, 3, 4. Lease rental. First year X andre, second year 2 lakh units, correct? 2x. Third year 3 lakh units, 3x. Fourth year 4 lakh units, 4x. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? X, 2x, 3x, 4x. You will get tax benefit on it, therefore, after tax, lease rental. So minus tax, 0.75x. Yes, minus 25%, 1.5x. 0.75 into 3, 2.25x into 4, 3x. Present value factor at 10%. 0.909, 0.826, 0.751. Next one, 0.683 ala. 0.751, 0.683. Present value of the cash flows. Multiply it. Yes, multiply and you'll get total answer. ಹೇಳಿ ಬೇಗ. Present value of cash flow is how much? Hilly, you have to tell me one by one. First year, tell me how much? 0.909 into 0.75, how much? Quickly.
0.68.
0.68172.
0.682, always 3 decimal places. 682x. Next.
1.239x.
1.239x. Next.
69.
1.690x. Next.
0.89.
2.049x. Add everything. How much is this? Add everything. How much is this?
5.66.
5.66. ಇನ್ನೊಂದು ಡಿಜಿಟ್ 66. 3 ಡೆಸಿಮಲ್ ಪ್ಲೇಸಸ್ ಇದೆ ಅಲ್ಲ. ಎಕ್ಸಾಕ್ಟ್ 5.66 ಬರ್ತಾ ಇದೆಯಾ? If that is the case, I need to put 0. If it is exact, then 5.660. 5.660x. Next. This is when it is client utilization pattern. Next one. Present value of after tax lease rentals. Present value of after tax lease rentals charged equally. Right here. Let annual lease rental is equals to, say, y. Let annual lease rental is equals to y. Right here. Y into 1 minus tax rate you have to minus, correct? Tax rate you have to minus into present value annuity factor 10%, 4 years. In the ಮಾಡಿದಿರ already. Y into 0.75 into ಎಷ್ಟು ಬಂದಿತ್ತು? 3 point. You have done this above
170.
3.170. Multiply this. How much are you getting? Multiply this. How much are you getting?
2.3775.
2.37.
75. So 8.
3, 7, 7, 500, 8. Y. 2.378 Y. How do I determine the lease rental value? Basically, whatever I've invested, that I have to recover. Agreed or not? Whatever I've invested, that I have to recover, right? So what is my investment today? What is my investment today? How much I've invested today?
10
lakhs.
10 lakhs. Yes, 10 lakhs. Adralli, a partial of the recovery we have already calculated. Tell me what is that? Partially I've already recovered. What is that? 10 lakh mele, I've already done some recovery already. What is that? What is already recovered? We calculated it. ಎಲ್ಲ ಮುಂದೆನೆ ಇರ್ಬೇಕು ಅವಾಗ ಗೊತ್ತಾಗುತ್ತೆ. 10 ಲಕ್ಷದ್ದು partial recovery is already done. What did we calculate?
Tax advantage,
On what?
present value of depreciation.
Depreciation. Depreciation is nothing but 10 lakh ಮೇಲೆ depreciation ಮಾಡಿದಲ್ವಾ? Everybody. Yes. Future, see, respective year depreciation I cannot compare with 10 lakh. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? Respective year depreciation I cannot compare with 10 lakh. But, all of you consider it now, but the present value of that is at T0, which is comparable with 10 lakh. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? The present value of the depreciation, tax advantage of the depreciation is as on date. That is already recovered. Therefore, I need not recover it from the lease rentals. Are you understanding? Yes. Tax ಇಂದನೇ advantage ಬಂದ್ಬಿಡ್ತಾರ ನಂಗೆ. Why will I have to recover it from the lease rentals? So, what is the amount to be recovered from lease rentals will be 10 lakh minus tax advantage on depreciation. Nityasri. Yes. I don't have to recover that. ಯಾಕಂದ್ರೆ ಗವರ್ಮೆಂಟ್ ನಂಗೆ ಕೊಡ್ತಾ ಇದೆ ಅಲ್ವಾ? ಅರ್ಥ ಆಯ್ತಾ?
Yes.
Everybody? Yes. In other words, when I'm considering interest cost, do I consider net of tax interest cost or do I consider pre-tax interest cost? What do I consider? Net of always, no? I consider into 1 minus t. Yes, for my calculations, I always take 1 minus t. Otherwise, I need to make a P&L income statement and then minus tax for all of it together. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? But when I'm not making an income statement, in that case, the tax advantage has to be considered somewhere, no? That is where I've considered here. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? ಒಂದು ನೀನು ಇನ್ಕಮ್ ಸ್ಟೇಟ್ಮೆಂಟ್ ಮಾಡು, ಅಲ್ಲಿ ಮಾಡ್ಕೊಂಡು ಮತ್ತೆ ಮಾಡು, ಬಟ್ ಇನ್ಕಮ್ ಸ್ಟೇಟ್ಮೆಂಟ್ಗೆ so much of information is not there. Are you understand? Yes. In fact, they're asking us to calculate the lease rentals. Yes. So, write down. Investment to be recovered from lease rentals. Investment to be recovered from lease rentals. There are 4 types actually. ಇಲ್ಲಿ ಒಂದು ಬರೀರಿ. When ಅದೇನು client utilization ಅಲ್ಲಿ when where just write down client utilization. ಇದೊಂದು. Second is annual lease rental, that is equal lease rental within bracket equal. This is one. Under client utilization, again there are two depreciation methods. Under lease rentals, there are two depreciation methods. First one here, SLM, unit of production. SLM, unit of production. ಈ ತರ ಬರುತ್ತೆ ಟೇಬಲ್. Right? And then obviously here particulars. Particulars. This is the table for you. Yes. First investment at T0 today 10 lakh. 10 lakh. You write full forms, huh? 10 lakh less tax advantage on depreciation. Hedi, SLM method. What's the tax advantage on depreciation?
1,98,120.
125. Next. UOP.
188,650.
Again, 198,125. 188,650. Yes. How much is this? Hedi bega.
801,875.
Investment to be recovered. Okay. So this is 801, 875.
875.
Yes. Next one.
811,350.
811,350. Next. This is all at what date? At T0. Correct? We are supposed to find out what should be the lease rental. Correct? Lease rental, we calculated something at T0. The present value of after tax lease rentals ಅದೆಷ್ಟಿದೆ ಬೇಗ ಬೇಗ ಹೇಳ್ತಾ ಹೋಗಿ. Just tell me quickly.
5.660x.
5.660x for client utilization pattern, correct?
Yes, sir.
Next, for SLM,
2.378.
y. 2.378y. Yes, therefore, lease rentals. ಹೇಳಿ ಇದು ಎಷ್ಟು ಬರ್ತಾ ಇದೆ? ದಿಸ್ ಇಸ್ ಫಸ್ಟ್ ಇಯರ್. ಓಕೆ, ಫಸ್ಟ್ ಇಯರ್ ಎಷ್ಟು ಬರ್ತಾ ಇದೆ ಬೇಗ?
1,41,674.
141,674. Next one.
Lakh 43,348.
Next.
Three lakh 37,205.
337,205. Last one.
341,190.
341,190. Now you should do working back. Did you understand? That will take a lot of time. We'll go through the answer directly. Yes. Oh, go to the answer part. Tell me the page number. RTP
25.
answer page number.
24.
Yes. 24. Okay. 24. Not sure how they have presented. Let's see. Okay. This is matching. 198,125 matching. Next. 188,650 matching. 5.660x matching.
Yes, sir.
2.3. Okay, here I considered y. It's okay. Doesn't matter. Okay, all of you. I considered y. It's fine. 2.378y. That is fine. Next. Are these answers matching? 141,674, 143. This is matching. 230. I think 1 rupee difference ಬಂತಿಲ್ಲ ನಮಗೆ ಅಲ್ವಾ?
Round.
ಅದು ನೋಡ್ಕೊಳ್ಳಿ. There I think 1 rupee. That is fine. Next. So now what we do is, all of you concentrate now. This table is there, right? Can you see this table? The
Yes.
table x na replace it with x value. Did you understand? You will get what is the rental to be charged. So for 5660, you need to do that. Clear? Look at this. Same thing is done here. 0.682x under SLM under UOP. Take the X values and then replace it, you'll get what is the present value of total after tax lease rental. It will match. Understood, everybody? This is the lease rental to be charged. Right? Next. Here, Y. So 3,37,206, 341,190. Correct? This is when it is charged equally. Correct? So you're charging 3,37,206. But to find out what is the. Have they asked this? ಹಂಗವ್ರು ಇದು ಕೇಳಿದಾರ ಅದೇ ಗೊತ್ತಿಲ್ಲ. Have they asked this requirement? Can you see read sub question 3, all of you? I'm not sure why they have done this. Can you read sub question 3 quickly?
Determine minimum lease rentals needed to recover the balance cost of investment after adjusting the tax shields on the depreciation under both the depreciation methods. If equip lease charge uniform equal rentals over 4 years, lease rentals follow the client's utilization pattern, that is 1:2:3:4.
Okay. So I'm not sure why they are proving statement showing present value of yearly lease rentals when charged equally anta kelidare. ठीक, anyway. So we found out X and Y, but anyway, to find out the present value of the lease rentals, all of you look at this now. This is Y, right? I think I've written this as Y. 3,37,206, 3,41,190. Okay, everybody. This is what? This is the present value annuity factor, correct? Based on PVAF, we got this, yes or no? Right? Based on PVF. So they're saying first year, what will be the present value annuity factor? 0.682x. How did we get 0.682x? Come back. Look at this. Your tax advantage into first year present value factor. When you add it, when you multiply, you get 0.682x. Clear, all of you? Yes?
Yes.
Now, 3,37,206. All of you do this into Madi. Into 0.909, you do how much are you getting?
6,520.
Sorry?
3,306,520.
And 75% of that?
89,89.
Sorry?
890.
229,890.
ಅಲ್ಲಿ ರೌಂಡಿಂಗ್ ಆಫ್ ಬರ್ತಾ ಇದೆ ಅಷ್ಟೇ, ಗೊತ್ತಾಯ್ತಾ? ಇಲ್ಲಿ 229,974 they're getting. That's all. That's the rounding off difference. So based on this only it is done, right? 3,37,206. ಅದ್ರ ಮೇಲೆ we're doing it. Clear, all of you? Yes. See how I got 3,37,206. ಅದನ್ನ ನೋಡ್ಕೊಳ್ಳಿ. 2.38. This is basically X will be the annual lease rental, correct or not? This is the fixed amount. Everybody, did you understand? That is the fixed amount. So therefore, this has to be discounted by 1 year, discounted by 2 years, discounted by 3 years, discounted by 4 years. Are you understanding? X is the fixed amount that is charged, correct? Each year you will charge 3,37,000. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? So obviously you have to discount it by 1 year, 2 years, 3 years, 4 years ಅಷ್ಟೇ. ಅಲ್ಲಿ ಕನ್ಫ್ಯೂಸ್ ಆಗ್ತಿದೆ ಬರೀರಿ. This is nothing but 3,37,206 divided by 1.1 divided by 1.1 into 1 minus 25 into 1 minus 25%. That is 1 minus t. First year is nothing but 3,37,206 into or divided by 1.1 into 1 minus 0.25. ಅದರಿಂದ ಇದು ಬರುತ್ತೆ. Then again 3,37,206 divided by 1.1 to the power 2, right? Into 1 minus t. Did you all understand? That's what I did. So basically ಅದು to the power 2 to the power 3 ಗೆ ಅವರು ಮೇಲ್ಗಡೆ ಮಾಡಿರೋ ರೇಷಿಯೋಸ್ ನ ತಗೊಂಡಿದ್ದಾರೆ. Did you understand? Right? That is how this problem is solved. That's it. Okay. Come to suggested answer. Yes, page number
517.
517. Just look at this problem. K Limited is replacing. ಇಲ್ಲೇ ಮಾಡ್ತೀನಿ. K Limited is replacing an existing machine. The replacement cost of the machine is 1 lakh now. Therefore, at T0 it is 1 lakh. And it requires, see, I have a habit of always writing the time, because immediately I know what is the time value of money or present value factor to be applied. And it requires maintenance of 20,000 at the end of every year for 5 years. Therefore, what will apply? Present value annuity factor. Artha aita? Yes. At the end of 5th year, it would have a salvage value of 10,000, right? Therefore, what will apply? Present value interest factor. The cost of capital is 14%. Immediately, what do they ask? What will be the equivalent annual cost of the machine? Yes. So today it costs 1 lakh, right? So 1 lakh plus, multiply this 20,000 into PBIF, idan madi. 20,000 into this 3.433. How much are you getting? 20,000 into 3.433, how much?
68,660.
Sorry?
68,660.
68,660, right? Minus terminal salvage value is a cash inflow, minus 10,000 into 0.519. 10,000 into 0.519, quickly.
5,190.
5,190. Idrad answer rate ಎಷ್ಟು ಬರ್ತಾ ಇದೆ? 1 lakh plus maintenance minus 5,190. How much? Bega?
163,470.
163,470. Correct? Yes.
Yes, sir.
Divided by PVF 3.433 equal annual equivalent cost. Yes, ಮಾಡಿ ಎಷ್ಟು ಬರ್ತಾ ಇದೆ?
47,617.24.
This is the answer. 47,617. This is actually ratio analysis. Last class, I don't think I've done this. Correct? Current liability they're saying is 1,60,000. Current ratio is 2:5. Therefore, current ratio is equals to current assets by current liability. Correct? This is 2/5 is equals to current assets that we don't know. Current liability is how much? 1.6 lakh. Therefore, current assets is equals to Hedi. 1.6 into 2 divided by 5 Hedi. 1.6 into 2 divided by 5 how much?
0.64.
0.64 is it?
Yes, sir.
64,000 is the current ratio. Now, liquid ratio they're giving is how much? Quick ratio is 2. Quick ratio formula. Current assets minus. Yes, current assets minus
Sir,
what?
shouldn't current ratio be, sir, shouldn't current ratio be 2.5?
2.5 ಕೊಟ್ಟಿದ್ದಾರಾ? ಓಕೆ 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 ಓಕೆ, ನಾನು 2:5 ನೋಡಿದೆ. ಸಾರಿ, ನಾನು 2:5 ಅಂತ ನೋಡಿದೆ. It is 2.5. ಬರೀರಿ 2.5 by current liability. Yes. So current liability into 2.5 is equals to current assets. Madi, current liability into 2.5. 1.6 into 2.5, current asset is how much? Bega?
80,000.
80 na? Coming out. 1.6 lakhs into 2.5. 4 lakh. Current asset is 4 lakh. Okay. Quick ratio. Current assets minus what? Current asset minus what? Bega ಹೇಳಿ. Inventory divided by current liability. Quick ratio they've given is 2 is equals to 4 lakh minus closing stock divided by current liability 1.6. Solve for closing stock. Solve for closing stock. 1.6 into 2 -4. I think 80,000 answer ಬರ್ತಾ ಇದೆಯಾ?
80,000. Yes.
80,000.
Yes.
Yes, this is how you have to do. Don't waste time in, ಕ್ವಿಕ್ ಆಗಿ ಮಾಡ್ಬೇಕಷ್ಟೇ. ಅರ್ಥ ಆಯ್ತಾ? ರಫ್ ಆಗಿ ಟಕ್ ಟಕ್ ಅಂತ ಮಾಡ್ಕೊಂಡು ಸಾಲ್ವ್ ಮಾಡ್ಕೊಂಡು ಮುಂದೆ ಹೋಗಿ. ವೆನೆವರ್ ಇಟ್ ಇಸ್ ಇಂಡಿಪೆಂಡೆಂಟ್ ಕ್ವಶನ್, ಈಸಿಲಿ ಯು ಕ್ಯಾನ್ ಡೂ ಇಟ್. ನೆಕ್ಸ್ಟ್, yes, I think this we have already solved. ಇದು ಆಯ್ತಲ್ಲ?
Yes.
Yes, done. Okay, look at this. Global Beverage Corporation is considering replacing one of its bottling machine with a newer or more efficient model. The existing machine was purchased 5 years ago for rupees 16 lakh. Is it relevant? At what rate it was purchased? It need not be relevant. Other than, only relevance would be what? Anybody? Only relevance would be depreciation of future, right? Depreciation of future and salvage value. Artha aita? And has a total useful life of 10 years. So therefore, what is the balanced life? It was purchased how many years ago?
5 years.
5 years.
5 years ago, right? Total useful life 10 years. Therefore, balanced life is
5 years.
5 years.
5 years. Therefore, depreciation of another 5 years is relevant. So cash flow idea illa. Tax advantage is relevant. Currently, the company can sell this machine for 9,60,000. Okay. The new machine costs 32 lakhs, having an estimated salvage value of 3,20,000 and a useful life of 5 years. So did you see here? I've always told this. In case of replacement, they will ensure that the new machine's life will be equal to the balanced life of the old machine. Otherwise, unequal life question agbidutte. Yes, with the new machine, annual contribution margin is projected to increase from 16 lakh to 18 lakh 40. Therefore, what is relevant? Only the increase in contribution, 2.4 lakh incremental, only relevant, correct? And operating efficiencies are expected to yield further annual savings of 3,20,000, relevant. Okay. Depreciation is calculated on a straight line basis over the machine's 5-year life. The company's cost of capital is 20% and corporate tax rate is 33%. You are required to calculate the net present value of the new machine given these present value factors. Right? So initial investment ali, what will be the net cash flow? Ready? Net cash flow. We'll look at the presentation later. This is a very simple problem. ಅದಕ್ಕೆ ಇಲ್ಲೇ ಮಾಡ್ತಾ ಇದ್ದೀನಿ. Net cash flow ಎಷ್ಟಿದೆ? The new machine cost is how much?
32.
New machine cost how much? 32 lakhs. Old machine, how much will I get?
9,60,000.
Yes. Tell me what is the net cash flow?
22,40,000.
22.4 lakh. Okay. Initial investment. Next. Operating cash flows. Adralli, first inflow. Yes, tell me. 2.4 lakh. Relevant. Correct. Year on year. Then, what is the savings? Annual savings of 3.2 lakh. Total 5.6 lakhs, relevant. Artha agta idya? Any other costs? Any other cost is there? Just check so that for me to minus before I consider depreciation. No other cost, correct? Cost enilla. Next. Tax advantage on depreciation. Again, I should consider only the differential depreciation. What is the depreciation of the new machine? Depreciation of new machine is 32 lakh minus salvage value is how much?
3,20,000.
3.2 lakh. Salvage value and operating cost same idea. 32 lakh minus 3.2 lakh divided by how many years? 5 years, correct?
Yes.
How much is this? How much is this?
5,76,000.
5,76,000. Okay. Old machine though, have they given any salvage value?
So
Have they given any salvage value? No, therefore not to be considered. Okay. Old machine depreciation is how much? Old machine depreciation how much? 16 lakh. SLM basis alva. SLM therefore 16 lakh divided by 10 years, 1.6 lakhs, correct? Yes. 1,60,000 differential. Subtract this. Yes, how much? 4,16,000.
Yes.
Either the tax advantage 25%. How much is that?
The tax 33%.
33, sorry. 33%. How much is that?
1,37,280.
1,37,280. Subtract. So this is what is relevant. This is what is relevant, correct? Okay, now look at the answer. Okay, they've taken tax paid on sale of existing machine. They've considered tax rate. Why? 1 second. Sometimes they consider, sometimes they don't. Your company's cost of capital, it is silent. In actually study material, they have given, okay, ठीक है, I'll bariri. Since I'll note ನಿಮ್ಮ answer ಅಲ್ಲಿ ಬರೀರಿ, notebook ಅಲ್ಲಿ ಬರೀರಿ. Since alternative answer ಇದೆಯಾ? Since ಬರೀರಿ. Since note, specific note. Since specific note. Okay, they have given. Okay. This is also fine. Look at this. If tax on sale of existing machine not taken, can you see this? If tax on sale of existing machine not taken, 22,40,000. Okay. Study material ange madidare. That's why it followed the same approach. So we got 22.4 lakh. Can you see this? Same answer. Next. Incremental contribution, cost of saving 5.6 lakh. Did we get the same answer? 5,60,000, yes or no? Then incremental depreciation is considered. Okay, they have considered full ಮಾಡ್ಕೊಂಡು ಮಾಡಿದ್ದಾರೆ. Okay, I took the tax advantage. ಇಲ್ಲಿ normally if I would have presented, so this is fine. What they've done is normal income statement ತರ ಮಾಡಿದ್ದಾರೆ. Okay, so 5,60,000 minus 4,16,000 incremental profit 1,44,000 less tax at 33%, profit after tax, add back depreciation, cash inflow. Is it clear, everybody? Yes. Then annuity factor of 3.605. So you get present value of cash inflow, and then salvage value 3,20,000 into 0.567, 1,81,440. Why? Because this is incremental. You have to consider this. Okay. Less initial cash outflow, and then NPV is considered. Okay, everybody. Easy sum. Let me see if they've given a lengthy capital budgeting problem. I don't think so. Last time when I saw. That's all. Okay. Write down. Next. Working capital management. Working capital management. Working capital. Working capital is equals to, that is net working capital. Net working capital is equals to, net working capital is equals to current assets minus current liabilities. Current assets minus current liabilities. It's below that. It is that portion of the current assets. It is that portion of the current assets financed by cost bearing funds, within bracket, say debt slash equity or both. Say debt / equity or both? Types of working capital. Types of working capital. 2 arrow marks. 2 arrow marks. Nitya, left hand side based on value. Based on value. Left hand side based on value. Again 2 arrow marks. Gross working capital, net working capital. Gross working capital, net working capital. Okay. Next, right hand side based on time. Based on time. 2 arrow marks. 2 arrow marks. Permanent working capital, temporary working capital. Permanent working capital, temporary working capital. Under gross working capital, write down current assets. Current assets. Under net working capital, CA minus CL. CA minus CL. Ali CL get star. CL get star. CL get star. Put a star mark down and write down. Yes, anybody?
Spontaneous current
Very
liability.
good. Spontaneous current liability. Spontaneous current liability. Right hand side. A permanent working capital ge put a downward arrow mark and write down core current assets, CCA. CCA, core current assets. Within bracket, also referred in MPBF. Also referred in MPBF, maximum permissible bank finance. Also referred in MPBF. Last one, temporary working capital. That is put downward arrow mark. Fluctuating, fluctuating, /seasonal, /seasonal. Example, bakery. Class reference. Example, bakery. Next. Write down. Working capital policy. Working capital policy. 2 arrow marks. Investment, finance. Investment, finance. Or that is financing. Investing policy, financing policy. Investing policy, financing policy. Right? For financing, write down. Right hand side. Similar to investing, refer class notes. It's not that relevant, so I'm not going to go too much in depth. I'll explain Martin, but Barsa last time. Investing. 3 arrow marks. 3 arrow marks. Aggressive, moderate, conservative. Aggressive, moderate, conservative. Aggressive. Under aggressive. Aim. What is my aim? High profitability. High profitability. How do I achieve it? Write down. Low current assets. Low current assets. Low current assets. Below that, therefore, save interest cost. Save interest cost. Save interest cost. 2 arrow marks. Left hand side. Low liquidity. Low liquidity. Right hand side. High profitability. High profitability. Below that, high risk, high reward. High risk, high reward. अर्थ ಆಗ್ತಾ ಇದೆಯಾ? High risk, high reward. However, below that, however, short-term solvency issues. Short-term solvency issues. Next, below that, may impact production process. May impact production process. Within bracket, opportunity cost. Opportunity cost. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? Because you have low current assets, sudden demand ಬಂದ್ರೆ I will not be able to meet. If there's sudden demand, I will not be able to meet. Right? Mark conservative. Under conservative. Aim. High liquidity. AIM, high liquidity / solvency. AIM is high liquidity / solvency. How? Write down high current assets. High current assets. Below that, therefore, high interest cost. High interest cost. High interest cost. Below that, low profitability. Low profitability. Right? So 2 remarks, that is high liquidity, low profitability. High liquidity, low profitability. Less risk, less return. Less risk, less return. Under moderate. Under moderate. Perfect balance of ಅಲ್ಲಿ ಎ ಅಗ್ರೆಸಿವ್ಗೆ ಎ ಬರೀರಿ, ಫಾರ್ ಕನ್ಸರ್ವೇಟಿವ್ ರೈಟ್ ಸಿ, ಫಾರ್ ಅಗ್ರೆಸಿವ್ ರೈಟ್ ಎ, ನೋಟೇಶನ್ ಕೊಡಿ ಎ, ಫಾರ್ ಕನ್ಸರ್ವೇಟಿವ್ ರೈಟ್ ಸಿ. Moderate is perfect balance of A and C. Perfect balance of A and C. Moderate risk, moderate return. Moderate risk, moderate return. Connect all the 3 arrow marks. Connect all the 3 arrow marks. Write down. Profit is the reward of. Profit is the reward of risk. Profit is the reward of risk. Balance has to be achieved. Balance has to be achieved between PLS, PLS, capital P, capital L, capital S, profitability, liquidity, solvency. Profitability, liquidity, solvency. Clear, all of you? This only it is. So if they ask you, right, working capital management and relationship with profitability, liquidity, solvency, risk return trade-off, these terminologies come, you have to explain all of these things. Clear, all of you? Yes, PLS, the triangle, if you remember, 3 points, P, L and S. Next. Write down. Operating cycle. Next. Operating cycle. It is the time taken. It is the time taken. It is the time taken in manufacturing or trading. It is the time taken in manufacturing or trading. Wherein the initial cash invested is converted to final cash through sale to customer. Write down below that, net operating cycle, NOC is equals to R plus W plus F plus D minus C. R plus W plus F plus D minus C. What is R? Raw material holding period. W is WIP holding period. C is creditors holding period. D is debtors holding period. Yes or no? Okay. R, W, F. F is finished goods holding period, debtors holding period, and creditors holding period is subtracted. I hope you all remember this. Yes. Next, below that, number of operating cycles. Number of operating cycles. Number of operating cycles is equals to 365 days / 360 days, depending on the question. 360 / 365 days divided by NOC in days. Right? Next, estimated working capital is equals to annual operating cost within bracket cash. In working capital management, we consider cash cost always. Okay. annual operating cost or annual operating cash cost divided by number of operating cycles. Divided by number of operating cycles. Write down below that. Raw material holding period, put hyphen and write. Raw material holding period, put hyphen and write. Is equals to average raw material stock divided by raw material consumed. Average raw material stock divided by raw material consumed into period, whatever it is, 365 days, 12 months, weeks, whatever, into period. Next, WIP holding period. Okay, below, before writing WIP, write down same tone for all formulas. Same tone for all formulas. Artha aita? So in the numerator you are having the average stock. Denominator you are having what? Yes, whatever is consumed. Understood? Right? Next. But however, I'll tell you the important points. Raw material ge underline raw material consumed. Clear? For WIP, put hyphen and write. Denominator COP. Average COP. Cost of production. For WIP, in the denominator, average COP, cost of production. Numerator in barutte, obviously average stock of raw WIP. Artha aita? Next, finished goods holding period, FG. For FG, consider denominator DR bariri aste, short form. DR is average COGS. Average COGS. Numerator average stock of finished goods into period. I hope you are able to understand. Then you go through the formulas anyway. Important points note down ಮಾಡಿ. Next, debtors collection period. Obviously, numerator ಏನು ಬರುತ್ತೆ? Average accounts receivables. Denominator is important. Write down average credit sales. Average credit sales. Creditors, for creditors period, it is again numerator average creditors or accounts payable divided by average credit purchases. Credit. So denominatorly credit sales ಬರುತ್ತೆ ಮತ್ತೆ credit purchase ಬರುತ್ತೆ ಇಲ್ಲಿ. Is it clear everybody? Next, estimation of working capital. Next heading, estimation of working capital. Market important. There are too many problems under this category. Okay, each category is important. Okay, so operating cycle ಒಂದೇ ರೆಡಿ ಇರೋದು, ಅದನ್ನ ಮಾಡಿ ಮಿಸ್ ಮಾಡಬೇಡಿ. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? ವರ್ಕಿಂಗ್ ಕ್ಯಾಪಿಟಲ್ ಪಾಲಿಸಿ only one problem. Do that. Why you want to miss it? Yes, what I would say is estimation of working capital, there might be 100 problems. You don't have time to solve 100. Important problems you solve and then go to the adjustments. Artha aita? But do not miss a single category. That you should not do. Yes, write down estimation of working capital. Yes. So format, current assets, under that current assets, under that ITC, IGE, all three have to write. Raw material, WIP, finished goods. IGE, inventory ge, raw material, WIP, finished goods. Below that, then trade receivables, right? Trade receivables, cash and cash equivalents. Then minimum cash required, they would have given normally maintain so much of cash balance. That should be considered. Minimum cash required, other current assets. Less current liabilities. Compulsory head is creditors. You can have wages, overheads, anything. Clear? working capital required barutte. Current asset minus current liability will get working capital required. To this add safety margin, and you will get net working capital required. Clear? Net working capital required. Ali, write down below that. Normally, cash cost approach is followed. Cash cost approach is followed. Cash cost approach is followed. Ali, important note. For debtors holding period, that is operating cycle, debtors holding period, that is operating cycle, consider sale value. Consider sale value. Clear? However, for estimation of working capital, yes, what will you consider for debtors? Cash cost of credit sales. Write down cash cost of credit sales. Cash cost of credit sales. Normally, cost of sales. Right? Normally the cost of sales. Clear? That is what you consider for debtors. For finished goods, CCOP, cash cost of production, CCOP. Alvareri, below this write down, that is exclude depreciation and profit. Exclude depreciation and profit. Now, formula for estimation of working capital. Formula for estimation of working capital. Current assets. Estimated, in the numerator write down estimated production units divided by period, could be 12 months, 365 days, whatever, divided by period into estimated cost per unit into average holding period. Into average holding period. Below that write down. For raw material, raw material cost per unit, and raw material holding period. For WIP cost per unit, and WIP holding period. ಅರ್ಥ ಆಗ್ತಿದೆ ನಿಮಗೆ? I am giving you the flavor of the equation and then substitute. For finished goods, COP, cost of production per unit. For finished goods, cost of production per unit, and FG holding period. For debtors, illi estimated credit sales units, in the numerator. Numeratorly credit sales units barutte. Okay, production units baralla, credit sales units barutte numeratorly. And into estimated cost sales per unit. That is cost of sales per unit. For raw material cost. For WIP cost. For finished goods, cost of production. For credit sales, that is debtors, you will consider cost of sales. Is it clear, everybody? Right? Into obviously average receivables correction period. Clear? For trade payables, credit purchase. Understood? That's it. That is estimation of working capital. Next, write down MPBF. Tandon Committee norms. Method 1. Open bracket. Method 1. Open bracket. Yes. open bracket, CA minus CL, CA minus CL, close bracket, into 0.75. Clear? CA minus CL. Obviously, CL against star mark. What is it? Spontaneous current liability. CL is spontaneous current liability. CA minus CL into 0.75. Understood? Next, method 2. Method 2. Method 2. 0.75 CA minus CL. 0.75 CA minus CL. Clear? Method 3. 75%, that is 0.75 open bracket. 0.75 open bracket. CA minus CCA. CA minus CCA. Core current assets, I give you the reference on top. Yes. CCA, close bracket, minus CL. Minus CL. Clear? CA minus CL. CCA into 75% minus CL. Method 1 greater than method 2 greater than method 3. Method 1 will be greater than method 2 will be greater than method 3. Next, payables management. Payables management. Write down. First point 1. 2/10, 2/10, comma net 45. 2/10, comma net 45. What is 2? Put a circle for 2. Use different inks. Red ink. 2. What is that? Yes, cash discount. Cash discount. For 10, put a underline. 10, downward arrow mark. Cash discount if paid within 10 days. Right? Cash discount if paid within 10 days. Net 45, that 45 is the credit period. 45 is the credit period. Okay? Albareri? Nothing is, or there is no free lunch. There is no free lunch in financial markets. There is no free lunch in financial markets / finance. No free lunch. Creditors which we assume to be free of cost. Creditors which we assume to be free of cost have inherent cost. Have inherent cost. Write down. We need to decide whether to accept cash discount. And pay upfront and pay upfront. That is on the 10th day in my above example. Okay. Yes, on the 10th day or pay on the 45th day or pay on the 45th day. Write down 2 arrow marks. Left hand side. If paid on 10th day, below that, write down inflow hyphen cash discount. Inflow hyphen cash discount. That is 2%. Clear? That is 2%. Next point. However, outflow. Interest / opportunity cost on the cash paid on 10th day for 35 days. Did you understand 35 days? 45 minus 10, 35 days though interest cost has to be considered. That is outflow. Clear? Right hand side. If paid on 45th day, if paid on 45th day, number 1, cash discount foregone, hyphen, cash outflow. Next, however, next point, interest / opportunity cost saved. Interest / opportunity cost saved for 35 days. For 35 days. Understood? You down? Formula. Formula. Simple interest. Using simple interest. Write down. D divided by 100 minus D into 365 by T into 365 by T. D divided by 100 minus D into 365 by T. Right? Next. Compounding formula. Open bracket. 100 by 100 minus D. 100 by 100 minus D to the power 365 by T to the power 365 by T to the power 365 by T. Clear? Next, receivables management. Amount tied up in debtors should be optimum. High debtors, high interest cost. High debtors, high interest cost. Clear? Low debtors, low interest cost. Low debtors, low interest cost. For low debtors, put another arrow mark or somewhere you give a connection, write down. However, opportunity cost has to be considered. That is sales lost. Are you understanding? When you have high debtors, when you give more credit period, below that write down. Higher credit period results in higher sales. And higher interest cost. Therefore, balance. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? Remember the cost of maintaining accounts receivables ABCD. Cost of maintaining accounts receivables ABCD. A, administration cost. Cost of maintaining accounts receivables ABCD. A, administration cost. B, bad debts. C, collection cost. D, discount. Admin cost, bad debts, collection cost, discounts. High debtors are one more cost is bad debts. When you increase the debtors, credit sales increases, interest cost increases, also bad debts increases. Supragna, what happened? Yes, you want me to repeat anything? Lost somewhere?
I didn't take it down. I thought you were telling.
ಬರಿಯೇ ಹಾ
Sorry, sir.
ನನ್ಗೇನ್ ಸಾರಿ, ನೀನ್ ಎಕ್ಸಾಮ್ ಬರೀತಾ ಇರೋದು ಬರೀ. ಎಸ್, ಕಾಸ್ಟ್ ಆಫ್ ಮೇಂಟೈನಿಂಗ್ ಅಕೌಂಟ್ಸ್ ರಿಸೀವಬಲ್ಸ್ ABCD. A is administration cost, ಸುಮ್ಮನೆ ಶಾರ್ಟ್ ಫಾರ್ಮ್ admin cost. B, bad debts. C, yes, collection cost. D, discount. Next, factoring. 2 arrow marks. Recourse, non-recourse. Under recourse, write down. Bad debt risk borne by company. Bad debts risk borne by company. Under non-recourse, write down. Bad debt risk borne by factoring agency. Bad debt risk borne by factoring agency. Mark this important. Mark this important. Here, you would write consider. Number 1. Number 1. Say 90% of the debtors, 90% debtors paid upfront by the factoring agent. Paid upfront by the factoring agent. Therefore, consider interest cost. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? Next, 10% held as, or certain percentage held as, right? Held as deposit. It is held by the, or withheld by the factoring agent. Right? Certain percentage is withheld by this factoring agent. Clear, all of you? Next. Gautami, are you there? Darshan. Next, consider bad debts cost. Consider bad debts cost if it is recourse. Next, factoring commission. Consider factoring commission. Yes. And ಕೆಳಗಡೆ, consider time value of money. It depends on when these cash flows are happening. Consider the time value of money. Mark this important. Factoring problems, high frequency examination questions. ಅರ್ಥ ಆಯ್ತಾ? Compulsory, you need to solve. Next, needs of cash management. Next heading, cash management. ಅದರಲ್ಲಿ types of cash demand / needs. Types of cash demand / needs. Within bracket TSP. 3 arrow marks. Transaction. Second arrow mark. Speculative. Third arrow mark. Precautionary. Transaction ke day-to-day operations. For transaction. For speculative, to take advantage of opportunities. Speculative, to take advantage of opportunities. Third one, precautionary. For unexpected events. Right? Bauman's EOQ model. Next one, cash management models. Adral Bauman's EOQ model, same as material chapter EOQ. Next, Alberari. 2 into A, that is the annual cash demand, total cash demand. 2 into A into financial cost. ಅದಕ್ಕೆ I think F notation had given. 2 into A F divided by carrying cost per unit per annum. That is the opportunity cost. Opportunity cost. A is the annual cash demand. Early you had ordering cost per order. Here you have financial transaction cost per transaction. Okay. There you had carrying cost per unit per annum. Here you have opportunity cost per annum. Understood? The same thing it is. Early annual demand of input. Here annual demand of cash. There ordering cost per order. Here financial cost per transaction. There carrying cost per unit per annum. Here opportunity cost per annum. That's all. Then all the assumptions apply of EOQ model. Clear all of you? Next. Miller-Orr model. Miller-Orr model. You have three limits. Higher limit or upper limit H. Return point Z. Return point Z. Lower limit O. Lower limit O. Cash balance when it reaches higher limit. Cash balance when it reaches higher limit. Put hyphen and write invest. Invest. It'll come down to return point. Understood? Next, cash balance when it reaches lower limit. Liquidate the investment. Liquidate, that is sell investment. Sell the investment. So it come back to return point. That is Miller-Orr model. Right? And obviously, for cash budget, important, refer class discussion. Cash budget, refer class discussion. Clear all of you? For cash budget, refer class discussion. I think sum and substance I have covered of the working capital management chapter. In this important areas, write down important areas or important problems. Refer export problem. For debtors, refer export problem. Factoring problem. Receivables and factoring, most important in working capital management. Artha aita? Working capital management, most important is receivables and factoring. Then estimation of working capital, I told you already. Estimation of working capital. Right? Others also important. Other note kodi. Clear all of you? Cash budget is easy. Bandre, will be easy. Other adjustments you need to know. Right? So they would have given, all of you concentrate, they would have given, right? 40% of the current sales is received in the current month. 50% of next month sales is received in current month. 30% of the second month sales is received in current month. Therefore, you need to draw that arrow mark and find out what is the cash flow today. Arthakta idea. Right? They would have given that 20% of, so 100% of sales of next month is procured in current month. Arthakta idea. 100% of the sales of next month is procured in current month. Clear? And there's 1 month credit period. Andre ಏನಾಯ್ತು ಆ ಮಂತ್ ಸೇಲ್ಸ್ ಆ ಮಂತ್ ಅಲ್ಲೇ ಪೇ ಆಗ್ತಿದೆ ಅಂತ ಆಯ್ತು. ಅರ್ಥ ಆಯ್ತಾ? I repeat. Purchases are made 1 month prior and there is 1 month credit period. Purchases are made 1 month prior and there is 1 month credit period. That means current month sales purchase is paid in current month. Sales to, so 1 month ಈಗ sales in current month. Clear all of you? Sales of next month is procured in this month. Then there is 1 month credit period. So that means a month sales to corresponding purchase is paid in that month itself. Cash flow perspective, I'm saying. Right? So these kind of adjustments will be given. You need to make sure. Clear all of you? Then there is a format for you to calculate what is the amount of cash balance before borrowing. You will have negative cash balance. Fine. If you get a negative cash balance, you borrow it. Understood? If you have surplus cash balance, after keeping the minimum cash balance required, the differential is repaid to the borrowing. Right? So these adjustments are there. Adana go through Madi. Most important, opening cash balance of different periods, do not add it up. In the total column, opening cash balance of the first period is taken, closing cash balance of the last period is taken. Clear? Yes? So this is your cash budget adjustments. Okay? Alright. Come to RTP. working capital. Very easy problem it is. I don't want to solve. Okay, we'll go through it ಅಷ್ಟೇ. The very easy problem. ನಾವು suggested answer problem solve ಮಾಡೋಣ. ಇದನ್ನು go through ಮಾಡೋಣ. ಬನ್ನಿ. Following information is forecasted by Pooja Limited for the year ending 31st March 2025. Look at this, all of you. Balance as at 1st April, balance as at 31st March, raw material, WIP, finished goods, debtors, and the creditors. Can you see this? So therefore, what do you think the question is about? Average is given. Where have we used average raw materials, average WIP? Where have we used? Anybody? Which formula? Everywhere I used average. The first one, if you check, yes, the first topic of working capital. Average. Then annual purchase of raw material, all credit. Cost of production, cost of goods sold, annual operating cost, annual sales, all credit. Yes. Where have we used? Can you see? In operating cycle, we have used average, correct? So you're required to calculate net operating cycle period, number of operating cycles in the year, amount of working capital requirement using operating cycle. Very easy problem. First find out in the working note average. Clear, all of you? And then use it to calculate the operating cycle period. Shall we see the answer directly rather than solving? It's a very easy problem. Yes. Look at this. So raw material storage period, average stock of raw material divided by annual consumption of raw material. Can you see? You get 53 days. R. Then W, average stock of WIP by annual cost of production. Then average stock of finished goods by cost of goods sold. This is important. You have to note down. Divide by what? Here cost of goods sold. Here annual cost of production. Adanella mark ಮಾಡಿ important. Then debtors correction period, average debtors divided by annual credit sales. Yes. Creditors period, average creditors divided by annual net credit purchases. Operating cycle R plus W plus F plus D minus C. Right? Number of operating cycles 365 days by operating cycle period, and annual working capital required is annual operating cost divided by number of operating cycles. Very easy problem. Okay. Come to suggested answer. Yes, I think this is working capital. Look at this. Yes. RG Limited has estimated that number of operating cycles in a year is 25-26 will be 3. The amount of working capital required after taking an estimate of 5% unforeseen contingency is 1,01,850. Other information is as under. Opening stock. This is again very simple. Opening stock of finished goods and closing stock will be lesser. Opening stock of raw material, closing stock of raw material. Again based on operating cycle this is. Right? What will be the total operating expenses and cost of goods sold for the year? I think you'll be able to do this. Okay. What will be the cost of production, finished goods storage period, raw material consumed, credit purchases? Please go to this again. Very easy. Okay. Let me come to R2C material. Yes, look at this from all of you. The management of Trucks Company Limited is planning to expand its business and consults you to prepare an estimated working capital statement. The records of the company reveals the following annual information. sales, that is domestic at 1 month's credit, is 18 lakh. Export at 3 months credit, okay? Sales price 10% below domestic prices is 8,10,000. Okay. Material used, suppliers extend 2 months credit. All these you will be able to do. Okay. This is not that important. What is important is this adjustment of 10%. Right? Please understand the cost will be same whether it is export or domestic. Agreed? The cost will be same whether it is export or domestic. Therefore, you consider this 8,10,000. If sold at 100%, what will be the value? From that you minus the gross profit percentage, that is 20%. Artha agta idya? To find out the cost, right? So 18 lakh is the sales, but export at sales, that is at 3 months credit, is with 10% below domestic market price. Therefore, if you divide this by 0.9, you'll get 100%. Other do 80% will be the COGS. Are you understanding? Right? That will be COGS. Then you take this, and after that you'll be able to do this problem. Is it clear, all of you? So if you see here, right? Domestic 18 lakh, this is fine. ಮತ್ತೆ ಇನ್ನೊಂದು ವರ್ಕ್ ನೋಟ್ ಮಾಡಿದ್ದಾರೆ ಅದಕ್ಕೆ. So this is all complicated. All of you do like this. So 18 lakh ಅಲ್ಲ, 8 lakh 10. 8.1 lakh divided by 0.90 into 80% ಮಾಡಿ ಎಷ್ಟು ಬರ್ತಾ ಇದೆ? Divided by 0.9 into 80%.
7,20,000.
Did you get this?
Yes.
Do like this. ಅರ್ಥ ಆಯ್ತಾ? 8,10,000 is 90%. Therefore, 100%, how much? 8.1 lakh divided by 90%. Other, the cost of goods sold is 80%. Into it, you'll get the answer. Clear, all of you? You don't have to do all this circus. Working note number 2 and all of that. Direct agi id ಮಾಡ್ಕೊಂಡು 7,20,000 can be arrived at. This is very simple. 18 lakh into 80% is 14,40,000. Total, you will get this. Understood? That is the most important adjustment. Other things, I'm sure you'll be able to do it in this. Okay. Then let me go through one factoring problem. Obviously, you should know even the material chapter. EOQ problems can be asked here. EOQ problems can be asked as part of working capital management. Yes, I think that's it. Yeah, look at this. Zomo Limited currently has a turnover of 120 lakhs, 75% of which is on credit. The variable cost is 80% and the credit terms offered are 2 bar 10 net 30. On the current sales volume, the bad debts are 1% and the company spends 1,20,000 annually. on administrating its credit sales, including staff salaries for credit checking and collection. These costs are avoidable. That means if factoring is done, this will be a cash inflow, right? Saved on factoring. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? In addition, 60% of the customers avail 2% cash discount. That means not debtors. Therefore, can I say 40% debtors? ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? 40% will be debtors, that is credit sales. Okay, 60 days on an average to pay after the date of sale. However, it is net 30. Can you see this? Net 30. Here it is 60 days. You are losing interest. Are you able to understand? Because of this delay, the book debts are financed by a mix of bank borrowings and own funds in the ratio of 1:1 ratio, right? So that means one is debt, the other is equity, with annual costs of 15% and 14% respectively. Okay. However, Zomo Limited is considering a dynamic discounting for its cash customers, which might incentivize more customers to pay earlier by increasing the discount rate. This could lead to potential reduction in bad debts to 0.8%. Right now, what is the bad debts? Current bad debts level, right? Where are they given? Look at this.
0.8.
0.8, it will reduce to 0.8, but may also increase the cost of discount offered to 2.5%. So currently the cash discount is 2%, this becomes 2.5. Bad debts is reduced to 0.8%. Okay, let's read further. A factoring firm
Bad
was
debts are one.
sorry,
Bad debts are 1%.
1%. Where is it given?
Sorry.
Volume.
Bad debts is 1%. Can you see this? It reduced to 0.8. That means 0.2% savings. Right? So this and this, there is 0.2% savings. A factoring firm has proposed a deal with the following terms: factor reserve 12%, 25 days guaranteed payments, interest charged 15%, commission 4% on receivables. In addition, the company also has the option to extend the credit period for its remaining customers who do not avail the discount to 75 days, which might increase sales by 10% but could result in an increase in bad debts to 1.5%. Right? So this information is given, you are supposed to find out. Right? So cash discount, cost, revised discount rate 2.5%, 60% are availing. Arthak. Therefore, say cost of discount would be, look at this now all of you, 75% of which is on credit anta kottidare. Can you see this? So Zomo Limited currently has a turnover of 120 lakhs, 75% of which is on credit. So multiply this all of you. 120 lakhs into 75%.
90.
Yes. How much?
90 lakh.
90 lakhs, correct? So they are availing 60% of it will accept cash discount. ಅರ್ಥ ಆಗ್ತಿದೆ ನಿಮಗೆ? So this is 120 into 75%, right? Because balance is cash sales. Is it clear? That doesn't come into picture only here. 120 into 75%, 90 lakh. Other the 60% will go for cash discount. That is now increased to 2.5%. Is it clear? Bad debt reduced to 0.8% due to dynamic discounting. So 90 lakh into 0.8%, 72,000. Administration cost saved is 1,20,000. Cost of financing the receivables. Right? So 10 days into 60%. Average collection period the same. I'll quote you the information again. Right? How it will be. So 60% of them will pay in 10 days. This is what? This is cash discount. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? Cash discount. The balance 60 days. So 40% are paying 60 days. Therefore, average collection period 30 days. Average receivables would be 30 days ಕೊಟ್ಟಿದಾರಾ? 90 lakh into 30 by 360. That is 7,50,000 and then others is given you. ಅದು ನೋಡ್ಕೊಳ್ಳಿ ಇದು. Factoring commission 4% is charged on 90 lakh. Okay. So this average accounts receivables, either the cost of bank funds, half of it is funded by, they have said own funds and debt funds, correct? So other half into 15%, you get 56 to 50, 50 to 500. And then you compare all the costs. Cash discount, bad debts, administration cost. Therefore, total in-house cost would be so much. Okay. Then for factoring, what is the cost? Factoring commission is a cost 4%. Interest charges on receivables, right? They have written 12%, 80% of 88% of receivables, interest cost for 25 days, 90 lakh minus 3 lakh 60, 88% into 15% into 25 by 360 is an important mark, Madi, all of you. Yes, please go through the question and solve this compulsorily. Right? So the factoring commission is paid upfront, right? So 90 lakh in the 3 lakh 60 is gone. Therefore, other mele interest charges will not be applicable. Did you understand? The balance interest charges is relevant for us. The balance interest charges is relevant for us. They are saying, all of you concentrate now. 90 lakh is the receivables. Yes or no? We calculate above 90 lakhs. Either do, please concentrate. Either in the 4% is gone as factoring commission. Therefore, 90 lakh minus 3.6 lakh uditu. Either do, they are saying 12% will be retained as a reserve. Therefore, 88% is what I receive. Did you understand? Right? So that's the calculation here. 9,60,000 minus 3,60,000 into 88%. And then obviously cost of funds. Here you have to consider cost of borrowing, okay? Into 25 by 360, depending on the number of days. Right? So factoring cost ಗೆ that considering borrowed funds for receivables which are not factored, you're considering own fund cost. ಅರ್ಥ ಆಯ್ತಾ ನಿಮ್ಗೆ? Right? Own fund cost. ಇದರಲ್ಲಿ ಎಕ್ಸ್ಟೆಂಡಿಂಗ್ ದ ಕ್ರೆಡಿಟ್ ಪೀರಿಯಡ್ ಕೂಡ ಇದೆ. ಓಕೆ, ಗೋ ಥ್ರೂ ಮಾಡಿ. ದಿಸ್ ಇಸ್ ಓಕೆ. ಬಟ್ ಫಸ್ಟ್ ಇದಕ್ಕಿಂತ ಮುಂಚೆ ಸಾಲ್ವ್ ದ ಕ್ಯಾಪ್ಸ್ ಮೆಟೀರಿಯಲ್ ಕ್ವಶನ್, ದಟ್ ಇಸ್ ಮೋರ್ ಇಂಪಾರ್ಟೆಂಟ್. ದಿಸ್ ಲುಕ್ಸ್ ವೆರಿ ಕಾಂಪ್ಲಿಕೇಟೆಡ್. ಅಂದ್ರೆ ಟೂ ಮೆನಿ ಅಡ್ಜಸ್ಟ್ಮೆಂಟ್ಸ್ ಅದೇ. ಇಫ್ ಯು ಗೆಟ್ ದ ಟೈಮ್ ಟು ಸಾಲ್ವ್, ನೋ ಆಲ್ ಯುವರ್ ಕಾನ್ಸೆಪ್ಟ್ ವಿಲ್ ಗೆಟ್ ಕವರ್ಡ್. ಬಟ್ ಹಂಗಂತ ಇದನ್ನ ಮಾಡ್ಕೊಂಡು ಟೈಮ್ ವೇಸ್ಟ್ ಮಾಡಬೇಡಿ. ಮೋರ್ ಇಂಪಾರ್ಟೆಂಟ್ ಇಸ್ ಟು ಡೂ ದ ಕ್ಯಾಪ್ಸ್ ಮೆಟೀರಿಯಲ್ ಪ್ರಾಬ್ಲಮ್, ಬಿಕಾಸ್ ದಟ್ ಇಸ್ ದ ಮೋರ್ ಫ್ರೀಕ್ವೆನ್ಸಿ ಆಫ್ ಕಮಿಂಗ್ ದ ಎಕ್ಸಾಮಿನೇಷನ್. ಅರ್ಥ ಆಯ್ತಾ? ಇದು ಬಂದ್ರೆ ಇಟ್ ವಿಲ್ ಬಿ ಅ ಡಿಫಿಕಲ್ಟ್ ಪೇಪರ್. If this question comes, it will be a difficult paper. But if you have solved it before, nothing like it. Right? But angan the preparation time don't waste. Right? I just wanted to cover some of the factoring commission related because it's important. I hope some of the adjustments you got used to it. Now, when you see the capital problems, you will be able to recall everything. Okay, everybody? Yes? Shall we take a small break and come back? Okay? Small alla, we'll take good break, then we'll come back because I want you to be a little fresh. Mukha tolkondella banni. Okay na? It is 7:35 now. We'll come back by what time? 7:35 andre 15 minutes. Let's take a 15 minutes break and come back. Okay?
Yes, sir.
Yes, all of you come back. Yes, everyone quickly come back. Gautami, Rajashri, Ashwini madam, Pranav. Quick. For theory, I would request you to keep the CAPS material, your textbook, not just the revision material. Textbook ಜೊತೆಗೆ ಇಟ್ಕೊಡಿ. Yes, if you don't have it with you, please get your textbooks. Yes, and a notebook and a pen. Okay. Yes, scale also. Wherever I tell you, keep underlining, highlighting. Let us understand. Yes, this we've already read. Yes, financial management is a managerial activity that deals with planning and control. Yes, Ali underline planning and control of firm's financial resources. Right? It deals with procurement of funds and effective utilization in the business. Right? The two basic aspects are efficient procurement of funds, effective utilization of funds. Efficiency is quantity related. Remember, example, employee cost or labor chapter, employee A, say take 2 hours, B takes 3 hours. Effective is quality related. Example, row one scheme, if you remember. Yes. How much we can do, how well we can do. It's like OT in SWOT, it's like SW in SWOT. Okay. We cannot create without an asset without creating a liability. Three important decisions for wealth maximization: financing decision, investing, and dividend decisions. Right? So, value of a firm is a function of all the three decisions. Okay? Investing, financing, and dividend decisions. Value of a firm will depend on various finance functions decisions. It is expressed as follows. Right? Then utilization, all of this is okay. Look at this now. Evolution of financial management, the three phases: traditional phase, transitional phase, modern phase. Traditional phase ಅಲ್ಲಿ ಏನ್ ಬರುತ್ತೆ? FM considered important occasionally, right? For big decisions like M&A, takeovers, ಅವಾಗ ಮಾತ್ರ FM was used. That is the traditional phase. Transitional phase ಅಲ್ಲಿ ಏನಾಯ್ತು? Day-to-day problems of the finance managers were given importance, like fund analysis, planning and control. In the modern phase, scope of FM has increased, helps in decision making, very important. All decision making. Many theories developed during the current phase, right? All the theories. Remember your capital structure theories. All of them during the modern phase. Is it clear, all of you? Yes. Scope of financial management. It involves determining size of the enterprise and determination of rate of growth, determining the composition of assets of the enterprise, determining the mix of enterprise financing, right? What is the debt and equity? This is capital structure decisions. Analysis, planning, and control of financial affairs of the enterprise. These are the scope of financial management, right? You can go through this paragraph. Okay. Scope and significance. Wherever funds are involved, financial management necessary as it attempts to use funds in the most productive manner, right? Optimizing the output, right? Go through this part. Effectiveness of finance function determines the strength of other functions. Now this is most important. Objectives, very, very important, right? Profit maximization objective, wealth maximization objective. This is short term, this is long term, right? Profit can no more be the objective of business than eating is the objective of living, right? And wealth, present value of benefit, How is wealth created? Present value of benefit minus present value of cost. That is nothing but wealth. This is nothing but your NPV for project. For project, we can call it as NPV. For other things, it is nothing but present value of benefit minus present value of cost. You have to go through this entire paragraph. Okay. All of this, you need to read it, right? And then remember only points. Remember only the points. Okay. This is important. Look at this now. Drawbacks of profit maximization. It is a vague concept, right? It does not explain whether it is short-term profit or long-term profit, right? Most of the concept of profit, you write down, it does not explain short-term or long-term, question mark, right? The profit itself is not properly defined, whether it is accounting profit or cash profit, right? Whether it is gross profit or operating profit or net profit. So many profits are there. Therefore, it is a vague concept, right? Second disadvantage. A firm seeking profit maximization must consider time value of money is ignored. Right here. TVM ignored, not considered. Major disadvantage. Next, the concept of profit maximization ignores factors of risk and uncertainty ignored. Right? Ignored. The relationship between risk and profit cannot be ignored, as risk and profit are directly related. Higher the risk, more is the possibility of profit and vice versa. Profit may not be the only objective of business. Right? Right? Not the only objective. Right? Growth is also important. Clear? These are the disadvantages of profit maximization. It's an extremely important. These 4 points are very, very important. It's asked repeatedly in examination. This is very, very important. All these 4 points. Wealth maximization, you have to read it like story, this part. Okay. Now, the concept of wealth maximization has many advantages. So, can you observe here? Profit maximization, the disadvantages say no. Wealth maximization, advantages say no. Is it clear, all of you? Yes, it is very clear, not vague. Right? It is the present value of future cash flows minus the cost of investment in finance action. It considers the time value of money. Only the disadvantages are all advantages here. It considers risk factor. Right? It takes into account the dividend policy. The objective of wealth maximization is in line with the objective of maximizing economic welfare of shareholders of the company. Right? These are advantages. So this summarizes the entire discussion. This is the summary. Summary. Objective. Profit maximization. Here, wealth maximization. What are the advantages? What are the disadvantages? Clear? How do we measure value of a firm? Stockholders hire managers to run their firms for them. Okay. Managers set aside their interest and maximize stock prices. But do they really do? Question mark. Right? Ilbariri, refer agency cost. Refer agency cost. ಆಮೇಲೆ ಎಕ್ಸ್ಪ್ಲೇನ್ ಮಾಡ್ತೀನಿ. Stockholders' wealth is maximized. Social wealth is maximized. So the functions are estimating fund requirements, procuring the funds, go through the paragraphs. Okay, paragraphs now go through and highlight the important points. A finance minister has to decide whether profits have to be distributed fully or retained. Dividend making decisions. Dividend decisions. Right? The financing decisions are investment, financing, and dividend decisions. All of this I've explained in the class. Okay? And so the elaborated is there. I'm sure if you read it, it's in plain English, you'll be able to understand. Next. Roles of finance executive in today's world. Right? What they used to do before, now what they're doing. Earlier, budgeting, forecasting, accounting, treasury management, right? Internal financial reports, Annual filings of investors, tax filing, right? If you can see, it's very limited scope. Now look at this. Now what they do, budgeting and forecasting, even now they do. But M&As, right? Then profitability analysis, pricing analysis, decisions, IT function, HR function, CFO does all of this now, right? Strategic planning, regulatory, risk management. So you can go through this chart. CFO only, who are there? Treasury manager, controller. Two things come. Finance controller, maximization of shares value. He has to take three important decisions. Trade-off between risk and return always. Right? You can see here, finance decision areas. They require support from accounting, support from all the other related disciplines, which results in shareholders' wealth maximization. These are the decisions: investment analysis, working capital management, sources, capital structure, dividend policy, analysis of risk and return. So if you see, it is just nothing but all. First chapter is a summary of all your other chapters, right? The relationship of financial management with other related disciplines. What is the relationship? Financial management and accounting. Treatment of funds. In accounting, what do we do? It is based on accrual principle. Here it's based on cash flows, right? Decision making. Chief focus of an accountant is to collect data and present only. Here, planning, control, and decision making. Artha aita? Right? So other disciplines like marketing, production, quantitative methods, right? For instance, finance managers should consider impact of a new product development. He should consider promotion plans, marketing area, right? Since their plans will require capital outlays. If you're developing a new product, you need capital. Therefore, you need to coordinate with other departments. That is what it is saying. Understood? Now this is again important. Important. Agency problem and agency cost. Concentrate all of you. A private limited company or a corporate setup, Ali, the shareholders are different, the management is different, correct? The shareholders are different, management is different. What is the long-term objective of the company? Wealth maximization. That is to maximize the shareholders' wealth, correct? But the question is that since there is a principal-agent relationship here, right? Principal is your shareholders. Your management is only acting like an agent appointed by the shareholders. Artha. So it is called agency problem. Why? Because managers or the board may not be incentivized for maximizing the shareholders' wealth. Did you understand? Why would they want shareholders' wealth? They would want their profits or their salaries or their remuneration or their incentives to be high. Right? So they might focus on profit maximization even though the long-term objective is wealth maximization. Did you understand the difference or the dilemma here? Correct? That is my agency problem. Understood? So with this knowledge, now let's read the paragraph. Agency problem, agency cost. In proprietorship concern, generally, there is no distinction between management and ownership. However, in a company, normally the management, that is board of directors, is separate from the owners or shareholders. This creates a principal agent relationship and leads to agency problem. The managers who are not shareholders, they have personal goals, say performance based commission paid as a percentage of sales achieved. Therefore, aggressive sales to maximize commission leads to high bad debts, reduces profitability. Did you understand? Yes. So agency problem, conflict of interest between owners and rights agents or managers can be addressed by, how do you address this? Aligning interest of the managers with the owners. Right? Obviously, it is easier said than done. How do you align managers' incentive with that of the owners? Maybe give them some, right? In company law, you would have understood that you cannot even give ESOPs to the managers, to the board of directors or the working directors. ESOP kodakagadu. Yes, employee stock option plan. So that is why it is easier said than done. For normal employees, you can give ESOP. Once ESOP are there, they become the owners. Then therefore, they also will be incentivized. But if he's a promoter, you cannot even give ESOP. Did you understand? If he's a promoter. Clear all of you? That is, but however, if a CEO is appointed, he can be given ESOPs. Right? So these are all ways in which you can align their interest with that of the stakeholders or the owners. Right? So what are the agency costs? Monitoring, bonding, opportunity cost, and structuring. Right? How do you structure it? All these are my agency costs. Clear, all of you? Clearly, so if you see this, this is your first chapter that I just went through. Illy. Right, look at this. So May 24, true or false, 4 marks. Objectives and advantages of wealth maximization, just now we discussed, 4 marks. Agency cost, 4 marks. Limitations of profit maximization objective, 2 marks. Basic functions of financial management, 2 marks. Did you understand? Yes? True or false, obviously depends on the statements. All of this asked, almost every examination you're getting 4 marks. Artha aita? Right? As part of the last question. Okay? Next chapter, types of financing. Yes. So we'll go through this after going through the chapter. All right. So there are different sources of finance. All of see different sources: long-term, medium-term, short-term, to be met by long-term source of funds, medium-term source of funds, short-term source of funds. What are the long-term sources? All examples are given here: medium-term and short-term. Understood? Right? So your short-term only. This is will also be covered in your working capital finances. It is there in both places. Illu ide, allu ide. Artha aita? Yes. So equity shares, preference shares, retained earnings, all of this you can go through. Yes. What are all the medium-term sources and short-term source of finance? Yes. Long-term. Revision material, please correct. I think it is given 3 years. Please correct it. It is 5 to 10 years long-term. Medium-term 1 to 5 years. Short-term up to 1 year. Revision materially, I think 3 years is mentioned. Make it as 5. That's as per your latest study material. 5 years. Make it as 5. Sources of finance. You have internal sources, external sources. Retained earnings is an internal source of finance. External sources, you have debt or borrowed capital and share capital. Share capital, you can be, it could be preference shares or equity shares. Borrowed capital can be loans from financial institutions, debentures or bonds and others. Debentures or bonds / bonds. Bonds also will come here, or others. Right? You have early stage, growth stage, stable stage. Look at this now. Early stage, there is high uncertainty. When high uncertainty is there, you will not get debt, mainly equity from angel fund. Okay? Mainly equity from angel fund. High to moderate uncertainty. Right? That means after, this is very initial stage. Initial stage. That little later, right? Once proof of concept established, artha ಆಗ್ತಾ ಇದೆಯಾ? That is this part. High to moderate uncertainty, at that time only equity only, still debt will not come, but venture capital is little bit bigger, right? Venture capital fund, bigger funds will come here, right? Debt again depends, not easy, right? Normally for loss making entities, you don't get debt. Okay, you still can procure, I'm not saying no, but depends on whether you can provide security. A lot of conditions are there. Growth stage, moderate to low uncertainty. Yes, now debt first preference, then venture capital, then private equity also will come, right? Low uncertainty, stable stage, debt. Why go for equity? Go for debt, right? Go for debt. Important source of finance. All of you look at this. ADRs, American Depository Receipts. These are non-US company listing in US stock exchange. Right? For example, say Infosys, right? Lists in US. This is called an ADR. How they will list? Through ADRs. Did you understand? How they will list? Through ADRs. Okay, their depository receipts issued by a non-US company in USA, governed by SEC, Securities and Exchange Commission, SEC short form, SEC. As the regulations are stringent, Indian companies tap the American market through private debt placement of why GDRs? ADRs idu. Okay, till ADRs. ADRs are, this is fine. ADRs are costlier than GDRs. What is GDRs? Ready? Bariri? Listing in non-US country. Anywhere. When you list other than a country, right? Say Infosys in London, through GDR. Did you understand? That's the global depository receipt. IDR, Indian depository receipts, right? To raise funds in foreign currency has been applied in Indian capital markets. It is applied here. When they want to come here, right? IDRs are similar to ADRs or GDRs in the sense that foreign companies can raise funds in India through IDRs. Right? Foreign companies can raise funds in India. How? Through IDRs. Did you understand? Debt securitization. All of you concentrate. Again, market very, very important. Debt securitization, very, very important. Say, I'm a financing company. Concentrate, all of you. Say, like an NBFC, I'm a non-banking financial company. Clear, all of you? I have lent money to my customers. Is it clear? They are not paying me. Probably they may not be paying in time. There'll be a lot of issues, management costs, etc. Understood, all of you? It has become an almost like an illiquid asset for me. Correct? It's almost become like an illiquid asset. What do I mean by illiquid assets? That means I cannot, not readily convertible into cash. Long-term loans given, taking a lot of time. Obviously, 5 years, 10 years loans. ಅರ್ಥ ಆಗ್ತಾ ಇದೆ ನಿಮ್ಗೆ? Right? If I want to convert this into liquid assets, right? I have to convert this into liquid assets. What I can do, all of you concentrate now. This is my asset. I have given. Now they say there are lot of customers in line. Say there are lot of people to whom I can give a part of this asset. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? Please understand, in my balance sheet, that is of the NBFC, these are sitting as assets. Correct, everybody? These are sitting as assets. I am not able to liquidate this. I'm not able to liquidate this. Clear, all of you? So what do? I issue units of this through a SPV, special purpose vehicle. So these assets are given to a special purpose vehicle. Remember, like factoring example ನೆನಪಾಗ್ತಿದೆ ನಿಮಗೆ? Factoring ಅಲ್ಲಿ ಏನ್ ಮಾಡಿದೆ, ನನ್ನ debtors I gave to them, they collected the debtors for me. Similarly, these assets given to an SPV, they give me cash. Clear? I got cash. That special purpose vehicle, then for it is an asset, right? They raise funds from the market. How? All of you concentrate now. Say they are going to get some income from this assets. Correct? They'll get interest cost, right? Say I've lent loans to all of you in the class. Clear, all of you? You will pay me interest, right? So instead of me, now I've given the special purpose vehicles, so that interest is coming in. That is cash inflow. Again, these loans, say there are 10 loans, but it is distributed among 100 people. ಅರ್ಥ ಆಗ್ತಿದೆ ನಿಮ್ಗೆ? 100 people who have then invested in this asset. ಸರ್ ಅವ್ರಿಗೆ ಇನ್ಕಮ್ ಏನು? ದೇ ವಿಲ್ ಗೆಟ್ ಅ ಫಿಕ್ಸ್ಡ್ ಇನ್ಕಮ್. ಸೊ 8% ಇನ್ಕಮ್ ಇದ್ರೆ 7% ಎಕ್ಸ್ಪೆನ್ಸ್ ಇರ್ಬೋದು. ಡಿಫರೆನ್ಷಿಯಲ್ 1% is my gain. Are you understanding? Yes. So what did I do? I would have taken 10 years for me to liquidate this. I immediately liquidated it through a special purpose vehicle. Got it? So converting illiquid assets, liquid assets, no, that is what is debt securitization. I'll barcode. Securitization is a process in which illiquid assets are pulled into marketable securities marketable securities that can be sold to investors. That can be sold to investors. Example, right now, example. Finance company has given many loans, within bracket asset. Next line. Finance company, put an arrow mark, SPV. Finance company, arrow mark, horizontal arrow mark, SPV, horizontal arrow mark, Mele Barari, sells the loans. ಅಲ್ಲಿ SPV ಗೆ put a backward arrow mark to the company and write down paste the company. Next, SPV put a downward arrow mark. Investors. A downward arrow mark ಅಲ್ಲಿ ಬರೀರಿ. Downward arrow mark ಅಲ್ಲಿ ಬರೀರಿ. Converts the loan assets to marketable securities. Investors in the upward arrow mark, write down. Purchases the securities. ಅರ್ಥ ಆಗ್ತಾ ಇದೆ ನಿಮಗೆ? Yes. So these are securities backed by an asset. Clear, all of you? Yes, backed by an asset. Right? Say, for example, you want to get into lending business. But ನಿಮ್ಮ ಹತ್ರ ದುಡ್ಡಿಲ್ಲ, ನಿಮ್ಮ ಹತ್ರ ಇರೋದು 1000 rupees, ಅದನ್ನೇ ಲೆಂಡ್ ಮಾಡ್ತೀಯಾ? ಅರ್ಥ ಆಯ್ತಾ? Yes, you cannot lend. What you do, but there is already some 10 lakh loan given to somebody. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? A portion of it you are purchasing. Clear, all of you? A portion of it you are purchasing. That is what converting illiquid assets into marketable securities. This entire process is called debt securitization. I hope I'm clear. Yes?
Yes, sir.
Right? Now read, you will understand. Debt securitization is a method of recycling of funds and is especially beneficial to financial intermediaries to support lending volumes. Simply stated, under debt securitization, a group of illiquid assets, say mortgage or any assets, etc., and that yield stable or regular cash flows like bank loans, consumer finance, and this thing are pooled together and sold to intermediary, Ilbariri SPV. This intermediary is nothing but SPV, special purpose vehicle. Right? They then use the debt securities, debentures normally issued by companies, bonds by public sector undertakings. Right? Advantages: the assets are shifted off the balance sheet. Converts illiquid assets into liquid portfolio. Right? Facilitates better balance sheet management. Originators' credit rating enhances. They're not performing well, so it enhances. Clear, all of you? Next, deep discount bonds, zero coupon bonds. You know what happens here? Deep discount bonds only today at zero, say issued at ₹100. So ಇಲ್ಲಿ ಬರ್ಕೊಳ್ಳಿ example. Face value say 1000, issued at 100 today. Maturity say 2 years. Right? This is called a deep discount bond. Right? If it does not carry interest, it's called zero coupon bond. Understood? Zero coupon, no interest. That means only one shot. 100 rupees you're investing today, you will get 1000 in 2 years. Understood, all of you? The interest or coupon is inbuilt in this. This is called a zero coupon bond and deep discount bond. Loan from commercial banks, beach finance. This is a short-term finance. Right? So what happens here? Listen. Bridge finance. You have taken one finance, ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? You have taken one finance. It could be a long-term finance, short-term finance, but it is taking time for that finance to come. It has been granted by the bank, but disbursement, say there is 3 months time or there is 20 days time. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? You need money right now. So a bridge finance is given between now and the other loan when it is disbursed. Did you understand? That is called a bridge finance. Right? So bridging the gap in short-term finance by the bank before disbursement of financial institutions. Example, R had applied to this thing and disbursement is expected on 30th September. He needs money from today, 1st August. Therefore, for this period of 2 months, to get a bridge finance. Understood? Venture capital financing refers to financing of new high risky ventures promoted by qualified entrepreneurs who lack experience and funds to give shape to their ideas. Okay, so but they have a good idea. Methods of venture capital financing, look at this, all of you. Equity financing, right? Long-term funds, there are 3 phases. First phase, no returns initially. Second one, say less than equal to 49% contribution. Ownership remains with the entrepreneur. Ownership remains with the entrepreneur. Right? Conditional loan. Okay, that means it is combination. Conditional loan is combination. It is repayable as a royalty after the venture capital, after the venture generates sales. So no interest is paid. Right? This is called a conditional loan. That means what? If sales is less, right? No royalty. However, after certain limit, then royalty will start. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? Royalty will start. That is why it's called a conditional loan. Income note is a mix of 1 and 2. Certain part equity, certain part royalty. Certain part equity, certain part royalty. That is called an income note. Participating debenture. Interest is charged in initial phase, no interest. Up to some level of operation, low interest. After a certain level, high interest rate. That is why they are called participating debentures. Now, this is also very, very important. New syllabus. Crowdfunding. I'll explain the concept. Listen, the same concept applies for everything. Crowdfunding. Today, right? Say you want to make a movie. All of you concentrate. A small budget movie. Say it costs 1 crore. 1 crore is also a big budget only, but for movie it's a very small budget. Did you understand? Right? Documentary you are making, 1 crore is the budget. Clear, all of you? Obviously, it's very difficult for you to find a finance for this. No producer will come and back it. What you can do is, but you have made some small short videos and you put on YouTube. Yes, this is real life. Real life examples I'm saying. Small short videos you put on YouTube. It became viral. Millions of views you're getting. But you don't have the fund to make a proper full-fledged documentary. What you can do, you can reach out to your subscribers, right? That and tell them, please become a part of my movie. I'll give you so much percentage return also. All of you invest. Did you understand? This is called crowdfunding, right? You would have seen small, some old lady is there. She needs money. Nobody's taking care, right? Or there's a small baby. One injection costing 10 crores. Some parents would have put up videos. Have you seen Milap app and all that? Yes or no? That is crowdfunding. Did you understand? That is crowdfunding. Equity you want to raise. You are not getting any venture capital. You are not getting angel fund also. But your products are famous amongst your customers. E-commerce are hakidira, Amazon only. Many people are buying. Are you understanding? You have made a brand name, but you're not getting investment. Crowdfunding. You can go to. There are platforms today that support this. Did you understand? Yes, that is crowdfunding. That is a basic concept. With that background, if you read, you'll understand. Yes, contemporary source of funding, crowdfunding, right? Means raising funds for a project from a group of people, normally via internet, social media, etc. Equity funding, the example that I just now gave. What are the sources? These are the platforms that support it. P2P lending, all of you concentrate now. In apps like credit, etc. Your credit score is generated. Credit to the Nodi, the Rahul Dravid ad. Yes, that is credit. Yes, sir. Alva. That is credit. Credit ಅಲ್ಲಿ ಏನಾಗುತ್ತೆ, people are using that platform to pay their credit card bills, to pay their electricity bills, to pay their EMIs. Understood? So what happens if you're paying within the due dates, your credit score is being maintained. Understood? So credit has a large database now. Clear? Now if you want to borrow money, ಬ್ಯಾಂಕ್ ಅಲ್ಲಿ ಸಿಗ್ತಾ ಇಲ್ಲ, ಕಷ್ಟ ಆಗ್ತಾ ಇದೆ. ಅರ್ಥ ಆಯ್ತಾ? ಯುವರ್ ಕ್ರೆಡಿಟ್ ಸ್ಕೋರ್ ಇಸ್ ಮೇಂಟೈನ್ಡ್ ಹಿಯರ್ ಇಟ್ ಸೆಲ್ಫ್. ದೇರ್ ಇಸ್ ಅನದರ್ ಪರ್ಸನ್ ಹೂ ವಾಂಟ್ಸ್ ಅ ಸ್ಟೇಬಲ್ ರಿಟರ್ನ್ rather than going for equity or stock market. He wants a stable return. Understood? But he wants certain little higher interest percentage. What he can do, he is also on credit. Peer-to-peer lending. So credit as a platform, I'm just giving an example, right? There are a lot of other platforms. Credit as a platform will connect the two parties. It will tell you, okay, this fellow has good credit worthiness. You also have good credit worthiness. You can lend money and then he can get interest. Obviously, risk is there of default. Did you understand? So that is peer-to-peer lending. Right? Then startup funding, for startup and donation-based funding, I told you, right? For medical research, etc. So all of these are crowdfunding examples. Please go through them. Important. Trade-off theory, where have you learned this? Capital structure. Refer capital structure discussion. And then read this like story. Artha aita? First adanu othkoli, then you come and read this as story, you will understand. Clear? Very, very, very important. Okay, bonds. Frequently asked questions from this. Name of the bond, foreign currency bond, foreign currency convertible bond. Yes, the bonds come at a very low interest rate. Okay, advantage to the issuer is that the issuer can get foreign currency at a very low cost because it is a foreign currency convertible bond. Clear, all of you? The risk is that in case the bond has to be redeemed on the date of maturity, the issuer has to make the payment, and at that time, the issuer may not have the money. Plain vanilla bond. Normal bond, what you issue, that is called plain vanilla bond. That means it will have a principal amount along with an interest rate. No options, nothing. This bond can be issued in the form of discounted bond or can be issued in the form of coupon bearing bond. This is called a plain vanilla bond. Convertible floating rate note. Floating rates. That means the rates are floating. Yes, convertible floating rate note is issued by giving its holder an option to convert. Underline that. I hope you're underlining everything. Option to convert into a longer term debt. It's a short term. It can be converted to a long term. That is why it's called convertible floating rate notes. Okay. It protects an investor against falling interest rates. So if you have invested, all of you concentrate now. Say you're an investor. You have invested in the bond. Understood? You have invested in the bond. If the bond's interest rate falls, obviously your income is going to fall. Right? So therefore, it is giving you an option to convert into a long-term debt. Clear, all of you? The long-term debt security can be sold in the market and the investor can earn profit. Okay? Capital gain is not applicable to floating rate notes. Next, drop lock bonds. It is a floating rate note with a normal floating rate. The floating rate bond would be automatically converted into a fixed rate bond if the interest rate falls below a predetermined level. So what does it mean? You're an investor, right? Investor, you want high interest. Okay. Say minimum interest that you need is 7%. Okay. Today, it is say 9%. If it goes up to say 10%, you are very happy. But if it becomes 6%, you are very sad. Correct? What happens when it touches 7%? If this is the limit that is set, drop lock, it will immediately convert to fixed rate. Did you understand this? It will immediately convert to fixed rate. That means it is a floating rate note itself. Floating rate and the gottala, it keeps fluctuating based on the market. Understood, all of you? Yes, it is fluctuating rate, but you don't want your interest rate to go below 7%. So when it reaches 7, I'm just giving an example. It could be any limit. Okay, drop lock. That's the drop lock. This is the drop, the maximum drop that it allows. Below that, if it is going, as soon as it touches this, immediately it's converted to a fixed rate note. Understood? So you get fixed income from there. This is called a drop lock bond. variable rate demand obligations, a normal floating rate note with a nominal maturity. The holder of the floating rate note can sell the obligation back to the trustee at par plus accrued interest. Right? Obligation is what? See, if you are an investor, right, you invest in bonds, correct? But you invest it for somebody, it is an obligation. Artha ಆಗ್ತಾ ಇದೆಯಾ? For someone, it is an obligation, correct? The company, for it is an obligation. The holder of the floating rate note can sell the obligation back to the trustee at par plus accrued interest. It gives the investor an option to exit, right? Sell back. Option to exit. So therefore, it is option. It is your right. You have a right to exit. For the seller, for the issuer, it is an obligation. For the issuer, it is an obligation. Yield curve note. It is a structured debt security. Yield increases when the prevailing interest rate declines. So yield curve note is used as a hedge. What happens is when the interest rate increases, the yield curve note decreases. Did you understand? They are inversely related. Inversely related. Okay. Say you have invested in a bond that is giving you interest, clear all of you, but you're worried that the interest rate will come down. What do you do? To hedge your risk, that means to minimize the risk, you invest in a yield curve note. ಅವಾಗ ಏನಾಗುತ್ತೆ, ಇದು ಕಮ್ಮಿ ಆದ್ರೆ ಜಾಸ್ತಿ ಆಗುತ್ತೆ. ಅರ್ಥ ಆಯ್ತಾ? Because interest rate note ಕಮ್ಮಿ ಆಗುವಾಗ yield curve note ಜಾಸ್ತಿ ಆಗುತ್ತೆ. They're inversely related. That is why it is used as a hedging mechanism. Yankee bond, right? They're denominated in dollars. Bond issued by a non-US bank, right, and issued in USA. That is called a Yankee bond. It is registered in SEC because it is issued in USA, obviously, right? Issued in tranches. Time taken can be up to 14 weeks. So it is for short term only, very, very short term. Interest rate in dollar LIBOR. Here actually LIBOR illa, but whatever. Euro bond. Euro means it has got nothing to do with euro, huh? It means outside your country. Simple. Outside your country. That's all. So euro bonds are issued or traded in a country using a currency other than the one in which the bond is denominated. That means what? Say it is a US dollar bond given to Japan. We call it as euro dollar. Euro dollar. Right? That is a euro bond. Did you understand? Euro dollar bond. US to in Japan. See, euro is used generally to refer to deposit outside the jurisdiction of the domestic central bank. Clear? So India do outside India, US do outside US. That is called euro. Is it clear all of you? Samurai bond. Samurai udit takshna, something you should remember. What? Samurais are where? Which country?
Japan.
Japan. Very simple. Okay. It is obviously denominated in yen, issued in Tokyo by a non-Japanese company. See, we are not, all these are foreign currency bonds. Huh? If you have seen the heading, all these are what? Foreign bonds. So obviously it has to be outside. Indian bonds issued in India will not come under foreign bonds. Did you understand? Japanese bond issued in Japan is not relevant here. Obviously, it is issued by a non-Japanese company in Japan. Right? Bulldog bond. Very simple. Who are these?
Dog.
Okay. One day they called us. Today we are calling them Bulldog, Pound, Sterling, Great Britain, and they only call themselves. Right? So it is denominated in, so Bulldog, Pound, Sterling keys, right? Sterling, Pound, Sterling, issued in London, right? Issuer, a non-UK company. Clear all of you? Obviously, London or London idre no use. Outsider issuing in London, Bulldog bond. Clear? Types of bond, callable bonds, puttable bonds. Call is a right to buy. Put is a right to sell. Barkoli. Right to buy, right to sell. It gives option to issuer to redeem the bonds premature. Okay? Buy back the bonds. Right? Redeem. Who will buy the bond? See, bonds are already issued. Therefore, issuer only has to buy it back. Did you understand? Premature, he can buy it back. Putable bonds. Right to sell. Investor has the right to sell. Option to sell before maturity. Indian bonds. India andre masala barlebeku. Masala bond. Right? Used for rupee denominated bond that Indian corporate borrowers can sell to investors in overseas market. I told you again, time and again. India to India, there is no. What is important is Indian, but it is rupee denominated. Did you understand? Rupee denominated. If it is not rupee denominated, what do you call it? Euro bond. I told you. India bonds outside, right? So rupee denominated in overseas market. These bonds are issued outside India, but denominated in Indian rupees. Okay. Masala bond. Euro bonds, you remember US example, that is best. Okay. Do not take India example here. India, though, these are Indian bonds. Clear, all of you? Main gade ellu India reference kodbedi. Example kodakidru of other countries you give. That is best. Municipal bonds issued by the municipality, right? For what? Say they want to make some infrastructure project. They need money for it. They can issue a municipal bond where you all can invest. Understood? For infrastructure. Government or treasury bonds issued by the government, right? Issued by the government of India, Reserve Bank. All this is treasury bonds. ESG bonds, right? Environment, social, and then governance. Look at this. Project based, that is green bonds and social bonds. Target based are called sustainability linked bonds. Green bonds are used for green projects. Social bonds for impactful projects. Sustainability are a combination of both. Okay. Debentures, convertible debentures, convert to equity, non-convertible, and then partly convertible debentures. All these are very easy. Types of debentures and the salient features. From PUC days, we have been learning, go through it. Lease financing, AS19, third of covered. Operating lease, finance lease. Can you all go through this? This accounts related, sale and lease back, leverage lease, yes, sales aid lease, all these open-ended and close-ended lease. Go through these explanations. Okay? Caps material. And then preferences. What are the types of preferences? Cumulative, non-cumulative, redeemable, participating, non-participating, convertible. LPUC discussions, please go through them. Short-term source of finance. Eitherly, bank advance, trade credit, all of these are there. Write down, open your notes book. Open your notes book, write down. Short-term source of finance. Short-term source of finance. It's also referred in working capital management. Okay, working capital management allu baruttidu. One is trade credit. That is your creditors. Clear, all of you? Spontaneous current liability ಇದು explanation ಕೊಡಬೇಕು. Plus trade payables management. Plus trade payables ಬರೀತಾ ಇದ್ದೀರಾ ಬರ್ಕೊಳ್ಳಿ. Trade credit. ಅಲ್ಲಿ ಹಿಂಟ್ಸ್ ಬರಿತೀನಿ ಅಷ್ಟೇ. That you have to use that hint to write in the examination. Trade credit ಅಲ್ಲಿ spontaneous CL. One hint. Second hint. Trade payables management. Inherent cost that is involved. Cash discount. ಅದೆಲ್ಲ explanation. Understood? Right? Second, accrued expenses. Accrued expenses. Adu kuda again working capital management discussion. You know the lag in days that we calculate to find out, right? That is also a spontaneous current liability. Advances from customers. They're paying you upfront in advance. That's also a source of finance, short-term finance. Next, important, commercial paper. Commercial paper, write down. Important, commercial paper. Unsecured money market instrument. Unsecured money market instrument. in the form of promissory note. In the form of promissory note. It is issued in denominations of 5 lakhs, 5 lakhs or multiples, 5 lakhs or multiples thereof. Below that, interest rate is equals to 1 year government bond yield. 1 year government bond yield. Next, treasury bills. Next, treasury bills. Maturities normally 14 to 364 days. 14 to 364 days. Issued by GOI, Government of India. Issued by Government of India. Next, certificates of deposit within bracket CD. Ali commercial paper ke within bracket CP. Commercial paper short form CP. Illi certificate of deposit CD. Maturity 7 days to 1 year. 7 days to 1 year. Issued by bank. Next, the bank need not encash the deposit before maturity. Full stop. However, investor can sell in secondary market. Next, bank advances. Under that, short-term loans. I am sure you'll be able to write this. Short-term loans. Next, overdraft. Write down. Excess credit balance in current account. That is called overdraft. Did you understand? Drawing more than the balance. That is overdraft. Next, clean overdrafts. Issued only to financially sound borrowers. Next, generally granted for a short period. Next, side heading, cash credits. Customer is given advance up to the limit within bracket determined by drawing power. Security is given by way of pledge or hypothecation of debtors and goods. Hypothecation of debtors and goods. ನೆಕ್ಸ್ಟ್ ಬ್ಯಾಂಕ್ ಅಡ್ವಾನ್ಸಸ್ ಆಯ್ತು. ನೆಕ್ಸ್ಟ್ ಹೆಡಿಂಗ್ ಫೈನಾನ್ಸಿಂಗ್ ಆಫ್ ಎಕ್ಸ್ಪೋರ್ಟ್ ಟ್ರೇಡ್ ಬೈ ಬ್ಯಾಂಕ್ಸ್. ಫೈನಾನ್ಸಿಂಗ್ ಆಫ್ ಎಕ್ಸ್ಪೋರ್ಟ್ ಟ್ರೇಡ್ ಬೈ ಬ್ಯಾಂಕ್ಸ್, ಅದರಲ್ಲಿ 2 arrow marks. ಲೆಫ್ಟ್ ಹ್ಯಾಂಡ್ ಸೈಡ್ ಪ್ರೀ ಶಿಪ್ಮೆಂಟ್ ಫೈನಾನ್ಸ್, ರೈಟ್ ಹ್ಯಾಂಡ್ ಸೈಡ್ ಪೋಸ್ಟ್ ಶಿಪ್ಮೆಂಟ್ ಫೈನಾನ್ಸ್. ಅಲ್ಲಿ ಪ್ರೀ ಶಿಪ್ಮೆಂಟ್ಗೆ ಬರ್ರಿ ಪ್ಯಾಕಿಂಗ್ ಕ್ರೆಡಿಟ್ ಫೆಸಿಲಿಟಿ, ಡೌನ್ವರ್ಡ್ arrow mark, ಪ್ಯಾಕಿಂಗ್ ಕ್ರೆಡಿಟ್ ಫೆಸಿಲಿಟಿ ಫಾರ್ ಬೈಯಿಂಗ್, ಮ್ಯಾನುಫ್ಯಾಕ್ಚರಿಂಗ್ and shipping goods overseas. Buying, manufacturing and shipping goods to overseas. The exporter should have a firm export order in hand. Firm export order in hand or irrevocable letter of credit or irrevocable letter of credit. It has to be liquidated within 180 days. Liquidated within 180 days. Next, types of packing credit. Types of packing credit. ಅದರಲ್ಲಿ ಬರೀ number 1 clean packing credit. Only on production of firm export order. Only on production of firm export order. ECGC cover should be obtained by the bank. ECGC cover should be obtained by the bank. Full stop. Margin has to be maintained. Margin has to be maintained. Next. Packing credit against hypothecation of goods. Packing credit against hypothecation of goods. Next, packing credit against pledge of goods. Against pledge of goods. Next, ECGC guarantee. Right? Against, I will bury against firm export order. Against firm export order. Next, forward exchange contract. Applicable if the bill is drawn in foreign currency. Applicable if the bill is drawn in foreign currency. Next main heading post shipment finance. ಇದೆಲ್ಲ pre shipment finance. Post shipment finance. Purchase/discounting of documentary export bills. Next, again ECGC guarantee. Next, advance against export bills sent for collection. Advance against export bills sent for collection. Advance against export bills sent for collection. Last one, advance against duty drawbacks, cash subsidy, etc. Advance against duty drawbacks, cash subsidy, etc. Next main type of short-term finance, ICD, intercorporate deposits, that is between two corporates. Okay. Public deposit, subject to RBI norms, subject to RBI norms. Okay. Next, one last topic I wanted to cover in working capital management. I will show the screen. You can take a screenshot of the screen. Then we can conclude. 131 to 137. Either do we missed that marks 10, no? Look at this, all of you. So types of financing, 20. Yes. Look at the questions asked. Features of crowdfunding we discussed. Leverage lease, advantage and disadvantages of raising finance by debentures, angel financing, ESG, environmental, social and governance bonds, features of bridge financing, callable, puttable, masala and drop log bonds. Can you see this? All of this what we discussed in today's class, right? But if you see, they're not repeating easily. This chapter, everything you should study. Don't miss anything. Understood? This chapter, study everything. Don't miss anything. Clear? It is not repeating. Yes, first chapter repeating barutte, but second chapter normally they are picking unique questions only, or from a very past examination question ಬರ್ತಾ ಇದೆ ಹಂಗಂತ am I saying that these questions will not come? It can come. I have been telling for crowdfunding important ಮತ್ತೆ May 24 ಅಲ್ಲಿ ಬಂತು. Yes or no? Like that. It can come back again. There's chance that this might come again because it's been long time. All right. Have I given notes on floats in your during the class? Anyway, I'll explain it. You can take a screenshot. Yes, types of float. Again, important. Types of float. You can see this. You can take a screenshot of this. BMCB, billing float, mail float, check processing, bank processing. Time between sale and mailing of invoice amount is called billing float. So basically the time that is taking now, you have done the sale, but invoice you're taking 3 days. You're losing so much of credit period. Understood? It adds to your working capital. Therefore, that's called billing float. Next, mail float. Time taken by the post office for reaching and processing the check. That is called mail float. Right? Check processing. Time taken for receiving, sorting, recording and depositing check to bank. Bank processing. Time taken by the bank for collecting money from customer. All of these are your types of float. This is called BCMB. Right? Short form BCMB or BMCB. Next, accelerate cash collection. To speed up collection of cash and reduce float time, you can use concentration banking or lockbox system. What is concentration banking? Again, take a screenshot. Establishing a number of strategic collection centers in different regions instead of a single collection center. See, the checks have to be collected or cash has to be collected. Did you understand? You have got 1,000 branches across the country. Yes, instead of having a centralized collection center, you can have regional collection centers. Yes, payment received by different collection centers are deposited with the respective local banks. ಎಲ್ಲೆಲ್ಲಿದೆ ಅಲ್ಲಲ್ಲೇ ಜಯನಗರ್ದು ಜಯನಗರ್ ಬನಶಂಕರಿ ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? Yes, which in turn transfer all surplus funds to the concentration bank of head office. Lockbox system to eliminate time between receipt of remittances by the company and deposited in the bank. The company rents the local post office box and authorizes its bank to pick up remittances in the box. You're telling bank only, boss, you go and collect the checks. Understood? That is lockbox system. That's it. With that, we have completed the theory discussion. Okay. So go through it. Second chapter and again revision material. All the problems what is there in types of financing. Other note koli. Matte first chapter, second chapter most important. Adadmele your working capital finances only whatever I discussed in today's class, and then your over capitalization, under capitalization frequently as examination. That is one topic, and then advantages, disadvantages of various conceptual things what you have learned can come. Clear, everybody? So theory na ignore madmadi. Please practice. Give some time for theory. Yes, Darshan. I think we can conclude the session. Whoever has doubts can stay back. Otherwise, thank you everybody. Bye all of you. Yes,
Thank you, sir.
Darshan.
Thank you, sir.
Thank you.